Good morning, everyone. As the MRAC designated federal officer, it is my pleasure to call this meeting to order. Before we begin this morning's discussion, I would like to turn to the members of the Commission and the MRAC Chair for opening remarks. We will start with Commissioner Ralston Benham, MRAC sponsor, followed by Chairman Tarbert, then Commissioner Quintens, followed by Commissioner Stump, then Commissioner Berkovitz, and finally Nadia Zakir, the MRAC Chair. Now we will have remarks from Commissioner Benham.
Thank you, Alicia. Good morning and welcome to a virtual meeting of the CFTC's Market Risk Advisory Committee. I want to thank Chairman Tarbert and Commissioners Quintens, Stump, and Berkovitz for joining today's meeting. As many of you know, we have a very busy week at the Commission, so I appreciate their time and their willingness to listen to this important meeting. I also want to thank and acknowledge the MRAC members, the subcommittee chairs for their tireless and hard work over the last few months, and the speakers who will participate on today's panels. I would also like to thank Nadia Zakir, the MRAC chair, for her leadership, and of course Alicia Lewis, the committee's designated federal officer, for her commitment to making the MRAC and its subcommittees a great success. Finally, I'd like to recognize and welcome several new members to the MRAC and several members who we've lost in the past few months as well. I'd like to acknowledge and thank for their past service Vincent Johnson from BP, Isaac Cheng from AQR, Ronnie Yarrett for Goldman Sachs, Kristen Walters from BlackRock, and Sebastian Kolik from Optiver. As we've lost them, we've also gained some new members, and I'd like to welcome them to the committee. Mr. Peter Borish, Chief Strategist at the Quad Group, Ms. Eileen Kelly, Managing Director for BlackRock, Mr. Graham Harper, Representative of the FIA Principal Traders Group, Ms. Sujatha Srinivasan, Securities Division at Goldman Sachs, Mr. Bill Toom, Legal and Regulatory at the Vanguard Group, Shelley Goodwin, Regional Compliance Director at BP Global Americas, and finally, Ameribor, which is going to be an organizational member of the Interest Rate Benchmark Reform Subcommittee, and its representative, Dr. Richard Sandor, who I'm very pleased to have as a representative and a member of the Benchmark Reform Subcommittee. There are a few words that could rightly illustrate the change that has occurred since we last met in December 2019, when we were, as I said, kicking on the heels of 2020. In the few short months since then, the COVID-19 pandemic has kicked back quite a bit, profoundly altering our country and the world. Every day, nearly all of our decisions and actions are impacted by COVID-19, whether we are logging on for our virtual work experience, choosing a dress shirt for a Zoom meeting, or putting on a mask to venture out for groceries. This global health crisis has pushed us further down a path of economic crisis. Comparable only to the Great Depression and the Great Recession, the last few months have demanded unparalleled fiscal and monetary intervention and broad-based local, state, and federal action not seen before in history. Social unrest has laid bare decades-long racial inequity, which our country's greatest leaders, like the late Congressman John Lewis, fought tirelessly for over many decades. However, without addressing these issues directly, which demands action by each and every one of us, our country cannot achieve its highest ideals of life, liberty, and happiness. I'm hopeful that we emerge from the pandemic with a society that more accurately reflects these ideals for everyone. As this swath of uncertainty reshapes the future of our country on what seems like a daily basis, it's easy to forget that today, July 21st, marks the 10th anniversary of the enactment of the Dodd-Frank Wall Street Reform and Consumer Protection Act. 2 short but challenging years after the 2008 financial crisis exposed the contagion that had built up within a system many believed to be safe, President Obama signed the landmark law that altered both the market landscape and scope of financial regulation. Many of the financial reforms enacted in the wake of 2008 served as well-placed shock absorbers during the extreme market volatility experienced in March of this year, shortly after the COVID-19 pandemic gripped its teeth on American soil. The CFTC and its sister regulators demonstrated that a regulatory foundation promoting financial stability by improving accountability through transparency and focusing on risk and risk transmission can be resilient in a time of crisis. While the last several months have seen a host of targeted interventions, our core regulations remain solid. And while all of us have had to reconfigure our social and work lives to reevaluate short and long-term goals, and to explore new means of accomplishing them, the lessons learned should further strengthen our conviction to support and advocate for policy that builds stronger, more resilient financial markets. It's been over 7 months since we last convened the full committee, but as the pandemic has demonstrated with technology, we can keep things running pretty close to schedule. Nothing pleased and impressed me more than hearing that the MRAC subcommittees, after a brief pause during the most difficult market and transition periods in March and April, continued to make progress. This morning, we will receive updates from the MRAC's 4 subcommittees: interest rate benchmark reform, climate-related market risk, market structure, and central counterparty risk and governance. I'd like to briefly address the latter 3 and then provide more in-depth comments regarding the interest rate benchmark reform subcommittee and the work being done by the CFTC and other official sector bodies across the globe. Much of the discussion today, specifically from the CCP risk and market structure subcommittees, will focus on the impacts the COVID-19 pandemic has had on market activity and structure and elements of central counterparty clearing. We will also hear from the Climate-Related Market Risk Subcommittee Chairman Bob Litterman on their progress. COVID-19 pandemic, itself a harbinger of the potential consequences of climate change, has further solidified my view that financial regulators must prepare for the risks that climate change poses to our economy, markets, and public safety. Tail risks, as we call them, although unlikely, are possible, and regulators, in concert with private market participants, must work together to build a more resilient and better prepared financial ecosystem for the future. Incremental investments today can lead us to better outcomes tomorrow. On that note, I am pleased many institutions and political leaders are thinking about sustainability as the foundations for a new, stronger, more modern economy. Closer to the CFTC and derivatives markets, just last week, the European Capital Markets Institute of the Center for European Policy Studies, in cooperation with ISDA, published a paper on the role of derivatives in sustainable finance. Among other things, the paper highlights how the derivatives markets can help renewable energy innovators, manufacturers, and financial institutions, to name a few, hedge a suite of risks through derivatives products as they each tackle climate change and also meet strong demand for ESG-related products. I'm hopeful that this becomes more than just the beginning. Turning back to today's agenda, we will begin this morning with an update from Tom Whiff, the chairman of the MRAC's Interest Rate Benchmark Reform Subcommittee and also chairman of the ARC. One of my last public presentations was at the 2020 ISDA SIFMA AMG Benchmark Strategies Forum in New York City. I used my time to provide an overview of the current efforts in the U.S. with a focus on the progress of the ARC and our own benchmark subcommittee and initiatives that were at the time upcoming. These initiatives included ISDA's decision to reconsult on how to implement pre-cessation fallbacks, a second opportunity to build consensus, and the MRAC's sponsorship of a tabletop exercise in advance of the October 2020 single-step proposals by CME Clearing and LCH Limited for the transition of discounting for certain products to SOFR. My word for that day was progress, and my message was borrowed from the ultimate Renaissance man, Bucky Fuller, who promoted working harmoniously like the crew of a ship toward the greater good and building new models when existing ones become obsolete. Bucky would be pleased that the pandemic has not slowed our collaborative and often cross-border efforts. Indeed, he would be pleased to know that it has further encouraged us to move towards the end of LIBOR and forward with a new model. As Andrew Bailey, governor of the Bank of England, noted last week, the COVID pandemic and the market turbulence that ensued further proved that LIBOR is not sustainable, noting low levels of underlying activity make it fragile and more susceptible to liquidity and amplification effects in financial markets. And heavy reliance on expert judgment does impact its robustness and sustainability. John Williams, president and CEO of the Federal Reserve Bank of New York, similarly remarked that the pandemic confirmed the resilience of robust reference rates that are a fair representation of the underlying market, noting, quote, on a backdrop of enormous turmoil and uncertainty, both in financial markets and the broader economy, SOFR was a dog that didn't bark or bite. As has been true of so much of our progress over the last few years, this success may not have attracted headlines, but it demonstrates that during a tumultuous period, the new reference rates are a proven solution. I'm pleased to report that on May 14th, ISDA published a report summarizing the final responses to its consultation of pre-cessation fallbacks for derivatives referenced to LIBOR. The consultation asked whether the 2006 ISDA definitions should be amended to include fallbacks that would apply to covered derivatives referencing LIBOR following permanent cessation of the benchmark or a non-representative pre-cessation date, whichever occurs first. ISDA plans to publish a supplement to the 2006 ISDA definitions and a protocol to allow firms to incorporate the fallbacks into new and legacy derivatives with a target launch in the near future. The protocol will be voluntary and will amend contracts only between two adhering parties, so it will be incumbent upon all market participants to sign on. In June, the Interest Rate Benchmark Reform Subcommittee held a virtual tabletop discussion. During a 5-hour interactive session, members used scenario analysis to identify areas that could strengthen the current discounting transition proposals. This exercise provided valuable insight into overall market preparedness, and I look forward to hearing from Chairman Whiff on the lessons learned from that exercise and any recommendations for potential action items. The ARC recently acted on one such item. On June 17th, the ARC filed a letter with the CFTC's Division of Swap Dealer and Intermediary Oversight. DSIO and Commission staff are monitoring the fluid situation relating to transition and the single-step event in October of 2020, and their response, as always, will be nimble and appropriate. The Commission has always and also been working closely with ARC on several related issues. In December 19, DSIO and CFTC's Division of Market Oversight and Clearing and Risk issued staff no-action letters providing relief to market participants relating to the transition of swaps referencing IBORs. More recently, the ARC requested each of the 3 CFTC divisions to consider revising the existing relief to better reflect new industry developments. I'm confident the Commission, in conjunction with the support of staff action, will continue to support appropriate relief to facilitate the transition. There's still much to be done, and we are all continuing to explore our options and propose new solutions. I have many times echoed the remarks of Governor Bailey that transitioning away from LIBOR should be market-driven, and I've also acknowledged that regulators and authorities have a critical role to play. I strongly encourage all market participants, large and small, to focus their energy and resources, if you haven't already, on transition away from LIBOR. It's incumbent on market safety and soundness and will result in more resilient financial markets. As we move through 2020, I think the word of the year is flexibility. We have many challenges and uncertainties, but with these come many opportunities. We need to embrace them all and continue to move forward together. I'm hopeful that what results is an even stronger financial system and a nation that truly reflects our highest ideals. I want to thank everyone for their participation. I hope everyone's doing well and staying safe. And again, thanks to the Commission and my fellow colleagues, the Chairman and Commissioners Quinten, Stump, and Berkovitz for joining us today, and all of the individuals who made today's meeting come to fruition. I appreciate your time, your dedication, and your commitment, and I certainly look forward to today's discussion. Thank you. Alicia, back to you.
Thank you, Commissioner Benham. Chairman Tarbert?
Good morning, everyone, and thank you all for attending this Market Risk Advisory Committee meeting, or the MRAC, via teleconference. I'd especially like to thank Commissioner Benham for his leadership and his staff for convening this meeting. I'm also grateful to you, Alicia, for being the designated federal officer and for organizing this meeting. And of course, I also must thank Nadia Zakir for serving as the MRAC chair, and all MRAC members for taking the time to share your valuable perspectives. A number of important issues will be discussed this morning, including climate-related market risk, CCP, risk and governance, market structure, and interest rate benchmark reform. These are all really important issues, and I look forward to the discussion. This meeting will also discuss the performance of the market during the early months of the COVID-19 pandemic in the United States. And this morning, I just want to say a few words about market volatility during this time, and then also about the LIBOR transition. So in terms of market volatility during the early months of the pandemic, well, we witnessed significant volatility in the derivatives markets, particularly in the early months. For example, we saw a historic drop in the May futures contract for West Texas Intermediate crude, which briefly traded at negative prices for the first time ever. Clearly, there were unique macroeconomic factors at play: a historically high supply of oil, a fight between Saudi Arabia and Russia for market share, and a simultaneous drop in demand that was unprecedented both in speed and severity due to the coronavirus. The markets were digesting a lot of information, and it happened to coincide with the expiration of a futures contract. The possibility of negative prices itself was not a surprise for the CFTC. For weeks, we had been in regular contact with exchanges in anticipation of such an event. To help markets prepare, we issued a joint staff advisory to remind DCMs, FCMs, and DCOs of their responsibility to prepare for the prospect that certain contracts may continue to experience extreme market volatility, low liquidity, and possibly negative pricing. We have completed an initial draft of a detailed forensic study of the West Texas Intermediate crude oil price aberration on April 20th that led to negative oil prices, and we plan to make that report public at some point this fall. The analysis points to the confluence of fundamental and technical reasons, including a few market structure considerations that have not previously highlighted, that we will address to ensure that the price formation, price discovery, reliability, and soundness of this important derivatives market that serves our U.S. energy industry is further strengthened. Now, one of the most interesting things about the recent market volatility is how well the derivatives markets have performed. Far from amplifying risk throughout the financial system, the derivatives markets so far have acted as shock absorbers. Unlike the 2008 financial crisis, derivatives have internalized the impact of market swings. And while no one can predict the future, the derivatives markets have been resilient in part because the CFTC has deployed tools to prevent financial contagion. Over the past few months, the CFTC has been focused on responding to the tremendous impact of COVID-19. First, the agency has continued to monitor closely and prioritize agriculture and energy markets. And as I just mentioned, we issued a joint staff advisory on market volatility. Second, we've issued additional targeted temporary relief to market participants. This includes relief to registrants listing new principals and to applicants for registration as associate persons from the requirement to submit a fingerprint card for those individuals. I'm proud how the CFTC has risen to the occasion, acting on a bipartisan basis to approve more than a dozen temporary relief measures since the crisis began. And as Commissioner Benham stated, this has been the year of flexibility. Third, we've continued to bolster the CFTC's customer education efforts. Times like this, unfortunately, create new opportunities for fraud, and we've increased our efforts to arm the public with information so they can detect and avoid these illegal schemes. And finally, the CFTC's advisory committees, including the MRAC, have been hard at work in enabling our commission to gain valuable insight from external stakeholders who are in the markets and on the ground. Finally, turning to LIBOR transition, I'm looking forward to the report by ARC Chairman Tom Whiff on the tabletop exercise conducted in June for the transition to SOFR. And I'd like to thank Tom, Commissioner Benham, and Alicia for their leadership in this exercise. The MRAC Interest Rate Benchmark Reform Subcommittee's work has helped set the path for what I anticipate will be a smooth transition away from LIBOR and other impaired interest rates. I'd also stress that the CFTC is in active dialogue with the ARC on various issues affecting the transition. We're working to provide reasonable relief to market participants to both encourage the transition away from LIBOR and to make that transition as smooth as possible. In closing, let me just emphasize how important these advisory meetings are to our commission and as we consider the most pressing issues facing our markets today. So thank you very much, everyone, for allowing me to be here, attend, and listen.
Thank you, Chairman Tarbert. Commissioner Quintens?
Good morning. Thank you, Alicia, and thank you for all of your work with the MRAC committee. No official opening remarks this morning. I'd just like to thank, as always, Commissioner Benham for his strong leadership of this group and all of the work that has been able to be accomplished and work left to do. Thank the chair, thank all the subcommittee chairs. Really appreciate everyone's efforts and initiatives to bring these issues in front of the commission. Thank you.
Thank you, Commissioner Quintens. Commissioner Stump?
Thank you, Alicia. I just wanted to commend you all for pulling such a comprehensive meeting together. Even long prior to the COVID-19 pandemic, the Market Risk Advisory Committee boasted a very ambitious agenda, and I want to commend Commissioner Benham, Alicia Lewis, and Chair Zakir, and all of the members for the committee for furthering those goals while also responding to the more immediate events that are impacting our derivatives market. As the Commission has managed the circumstances of the past few months, I've found that engaging with all of the CFTC advisory committees has become even more critical, and it's become a tremendous resource to the Commission. So I also wish to thank all of the members of the advisory committee for volunteering their time and expertise for the benefit of our efforts, and I look forward to all the presentations today. Thank you.
Thank you, Commissioner Stump. Commissioner Berkovitz?
Thank you, Alicia. Good morning, and good morning to all the MRAC committee members. I want to thank Commissioner Benham for his leadership on the MRAC and bringing this very timely meeting to our attention. It's absolutely critical that we stay informed by market participants to try to keep up with all the significant events in the market that are occurring at this time, and there's no better way than to get it straight from market participants. Unfortunately, we've been managing under social distancing to accomplish the work of the Commission, but although we can accomplish what we need to do, it's never really as effective as when we can have in-person meetings, people coming in and out of the building, and our ability to visit people throughout the country and the world in these markets to learn firsthand. So meetings like this are especially opportune and appropriate, and I'm looking forward to today's discussion. In addition to Commissioner Benham, I'd like to thank both Nadia and you, Alicia, for all the work you put into this. And finally, I'd like to wish everybody a happy Dodd-Frank Day. Thank you.
Thank you, Commissioner Berkovitz. Many thanks to the Chairman and the Commissioners for their opening remarks. Now I would like to turn to Chair Zakir for her remarks and to start today's discussion.
Thank you, Alicia. Good morning. Let me start by thanking the Commission, including Chairman Tarbert, Commissioners Berkovitz, Stump, and Quintens, and in particular Commissioner Benham, for his sponsorship and support of the MRAC. Special thanks to Alicia Lewis for her leadership in organizing today's meeting. I also want to thank the members of the MRAC, and in particular each of the subcommittee chairs, for all of their very hard work over the past several months in hosting meetings, setting agendas, and furthering the work of the committee despite the challenges posed by the global pandemic. Today's MRAC discussion will center around the impact of the COVID-19 pandemic on various aspects of the derivatives market. As described in the agenda, we have a number of important updates from each of our subcommittees, including moderated discussions, and I look forward to hearing from our members on their respective experiences and perspectives with respect to the impact of COVID on the functioning of the derivatives market. Before we begin, we would like to do a roll call of the members and speakers on the phone so we have your attendance on the record. After Alicia says your name, please indicate that you are present, and then please mute your line.
Okay. Nadia Zakir, PIMCO.
Here.
Salman Benai, IHS Market.
Here.
Stephen Berger, Citadel.
I'm here.
Richard Berner. Richard Berner. Dick, take yourself off mute. Okay. Lee Betzel.
I'm here, Alicia.
Peter Borish, Quad Group. Peter Borish, Quad Group. Can everyone please mute their phones? Peter Borish, Quad Group. Biz Chatterjee, Citigroup.
Hey, Alicia, it's Biz.
Alicia Crichton, FIA.
Hi, I'm here.
Shelley Goodwin, BP.
I'm here.
Matthias Graulich, Eurex.
I'm here, Alicia.
Graham Harper.
Hi, Alicia. I'm here.
Frank Hayden, Calpine.
Hi, I'm here.
Lindsay Hopkins, Minneapolis Grain Exchange.
I'm here.
Annette Hunter, Federal Home Loan Bank of Atlanta.
I'm here.
Dimitri Carusos, Nodal Exchange.
Hi, Alicia. Good morning. I'm here.
Eileen Kiley, BlackRock. Eileen Kiley, BlackRock. Operator. Eileen Kiley, BlackRock. Derek Kleinbauer, Bloomberg Seth. Derek Kleinbauer, Bloomberg Seth. Laura Klemple, DTCC.
I'm here.
Robert Mangrelli, Chatham. Robert Mangrelli, Chatham. Kevin McClear, ICE.
Hi, good morning. I'm here.
Dennis McLaughlin, LCH.
Good morning, present.
Craig Messinger, Virtu.
Present, Alicia.
Dale Michaels, OCC. Dale Michaels, OCC. John Murphy, Commodity Markets Council.
Good morning.
Sam Priyadashi, Vanguard.
Good morning, Alicia. I'm here.
Jonathan Rafe, Nomura.
I'm here, Alicia. Thank you.
Marnie Rosenberg, JP Morgan.
Good morning, Alicia. I'm here.
Jim Shanahan, CoBank.
Good morning, Alicia. I'm here.
Lisa Shemi, SIBO.
Hi, Alicia. I'm here. Thanks.
Betty Simpkins.
Good morning. I'm here.
Tyson Slocum, Public Citizen.
Good morning, present.
Sujatha Srinivasan, Goldman.
Good morning. I'm here.
Marcus Stanley.
Tom Witch is here.
Marcus Stanley, Americans for Financial Reform. Susie White, HSBC.
Yes, I'm here, Alicia.
Scott Zucker, TradeWeb.
Yeah, I'm here. Good morning.
Bob Steigerwald, Chicago Fed.
Present.
Janine Tramontana, New York Fed. Janine Tramontana, New York Fed. Okay, just in case if people have joined since I started the roll. Richard Berner. Peter Borish. Peter, I need you to unmute yourself so I can have you on the record. Derek Kleinbauer. Eileen Kiley. Rob Mangrelli. Dale Michaels, Marcus Stanley, Janine Tramontana. Okay. So subcommittee representatives, please unmute your phones. After I say your name, please indicate that you are present, then mute your line. Tom Whiff.
Present.
Bob Litterman. Bob Litterman. And that concludes the roll call, Nadia.
Thank you, Alicia. Just a few logistical reminders. Committee members and speakers, please keep your phones on mute during the presentations and refer to the meeting instructions should you wish to make a comment or ask a question. I will recognize the members who wish to speak. If there are follow-up comments or questions after your initial statement, please be sure to state your name and your firm. All of the slides and presentation material referenced on today's call are available on the Commission's website. Turning to today's agenda, our first order of business is a status report from our 4 subcommittees, which cover interest rate benchmark reform, climate-related market risk, market structure, and CCP risk and governance. MRAC members, I will open the floor to questions after each subcommittee's report. Again, please refer to the meeting instructions for directions on how to ask a question or make a comment. With that, we will start with the Interest Rate Benchmark Reform Subcommittee. Many thanks to the subcommittee and its chair, Tom Whipp, Vice Chairman, Institutional Securities at Morgan Stanley, and Chair of the Alternative Reference Rates Committee for all of the progress and great work thus far. Tom, please provide your report.
Thank you very much, Nadia. I want to take a moment to thank Commissioner Benham and Alicia Lewis for their leadership on this work. Nadia, your support from the MRAC, the broader Market Risk Advisory Committee, and the rest of the commissioners and the chair and staff of the CFTC for the continuing support around the work of this subcommittee. In particular, the subcommittee membership since we last spoke has expanded materially, and we feel it covers a diverse set of views and perspectives, and we thank the CFTC for the work involved and the support for this expansion. I'd also like to thank the members of our subcommittee, both pre-existing members and newly added members, for their hard work over the past several months. The tabletop exercise that we conducted on June 2nd was made possible by countless hours of work from all the members. I continue to be appreciative of the group's commitment towards the MRAC's goal for us to be additive to the LIBOR transition efforts from the ARC and other groups. And I'd like to begin today by first recapping key developments in the LIBOR transition that have occurred since we last spoke in December, and then we'll provide an overview of the subcommittee's tabletop exercise that explored the proposals from CME Clearing and LCH Limited regarding the single-step transition for discounting and price alignment interest for certain products scheduled for October of this year, 2020. So first, since December, there have been a number of important developments in the LIBOR transition. Some have been already mentioned based on the comments we heard from the official sector last week. And these are driven by both regulators and market participants, industry groups, and central bank working groups, as well as this subcommittee. The regulatory developments include the following. The Financial Stability Board and the Basel Committee on Banking Supervision published a report on supervisory issues associated with the benchmark transition. The Federal Financial Institutions Examination Council, or FIFIC, on behalf of its members, issued a statement to highlight the financial, legal, operational, and consumer protection risks that will result from the expected discontinuation of LIBOR and encourage supervised institutions to continue their efforts to prepare for this change and address its associated risks. U.S. Treasury published and received comments on a request for information exploring the possibility of issuing a SOFR-indexed floating rate note. The Financial Accounting Standards Board issued an accounting standards update to provide temporary optional guidance to ease the potential burden in accounting for reference rate reform. I would also like to note a few UK-specific regulatory issues that do have global implications for the transition away from LIBOR. The UK government announced their intention to legislate to amend and strengthen the existing regulatory framework for critical benchmarks such as LIBOR, rather than directly to impose legal changes on LIBOR referencing contracts that are governed by UK law. In particular, they suggested they will introduce amendments to UK benchmark regulation to ensure that the FCA's powers are sufficient to manage an orderly transition from LIBOR. This may enable the FCA to direct a methodology change for a critical benchmark in circumstances where the regulators found that the benchmark's representativeness will not be restored and where action is necessary to protect consumers and or to ensure market integrity. The FCA and the Bank of England released a statement on the impact of the coronavirus on firms' LIBOR transition firms, noting that the ultimate year-end 2021 deadline persists. Other global regulators have corroborated this view in very clear terms. Moving to market developments, the ARC has been hard at work this year, increasing the frequency of our meetings substantially, particularly during the challenges we faced during COVID. Some of the products we published are, first, the best practices on the continued use of USD LIBOR, which provides date-specific guidance to market participants on when it is appropriate to end production of new contracts referencing USD LIBOR on a product-by-product basis, and also lays out a series of steps along the way, inclusive of using fallbacks and other tools that have already been put in place by the ARC. We've also put out a tool to help firms move internal systems and processes away from LIBOR, introduce fallback language for LIBOR index student loans and recommended conventions for using SOFR in new student loans, updated recommended hardwire fallback language for syndicated loans, details around the calculation of the ARC recommended spread adjustment for cash products utilizing ARC fallback language, and also provided recommendations for swaptions impacted by the CCP discounting transition to SOFR. A webinar providing an overview of the ARC's proposal for New York State legislation to deal with certain tough legacy cash products is also available on the ARC's website. Away from the ARC, ISDA is in the final stages of publishing a protocol to incorporate new fallback language into legacy derivative contracts, as has been mentioned earlier, which is based on input from several market consultations over the past 2 years. It should also not be understated how valuable the MRAC subcommittee's contributions have been to the ongoing transition away from LIBOR, especially in light of the tabletop exercise that we're going to present today. So if we could just move to page 2 in the presentation. On background, at our last meeting, December 2019 MRAC meeting, this committee voted to hold a tabletop exercise regarding CME Clearing and LCH Limited single-step proposals for the transition of discounting and price alignment interest for certain products to the Secured Overnight Financing Rate, or SOFR, scheduled for October 2020. The MRAC's Interest Rate Benchmark Reform Subcommittee was tasked with the planning and execution of that exercise. Due to COVID-19, the subcommittee opted to have a virtual tabletop discussion because of the complexities associated with conducting that virtual trading simulation. In this format, our subcommittee reviewed the potential implications of the discounting transition for market participants under 7 different scenarios. I'll read through them. So the first scenario was processes at both CCPs go according to plan, which was the base case. Scenario 2 was a failed auction for discounting risk swaps. Scenario 3 was some form of an operational failure. Scenario 4, a member default. 5, an FCM not operationally prepared for CCP discounting. 6, pre-funding needs or risk limits that will be required in advance of the single step. And scenario 7, COVID-19 related interruptions. So please turn to page 4. Entering the tabletop exercise, the subcommittee laid out key objectives for our discussion. Of utmost importance, we wanted the tabletop to be an educational experience for those involved, and to identify any potential areas or gaps or weaknesses or misunderstandings of the CME and LCH plans that could potentially impair the success of the discounting transaction when it occurs in October. We also sought to address issues raised during the tabletop via recommendations to market participants, as well as points of consideration to the U.S. official sector. So in looking through this, the key we wanted to lay forth was that there was a clear understanding that we could make sure that we could, identify and hopefully eliminate misunderstandings through education, explore how participants could react to these problems, highlight differences between the proposals from CME and LCH, but not reconcile. Clearly, we're moving down a path with certain different models being employed by each clearinghouse, and really assess the ability for everyone to have a clearer understanding of that, and really call out potential weaknesses that could be enhanced and corrected before we get to October. So turning to page 5, during this robust roundtable discussion, a number of key issues became apparent. There are some gaps in understanding among market participants about the precise timing of discounting transition milestones, as well as the dynamics of CME and the LCH auction processes. An auction in which some or all of allocated discounting risk swaps are not liquidated, despite the end user's election to offload these swaps, could be potentially disruptive to the pricing and liquidity of SOFR instruments, potentially leading to unanticipated volatility for the market overall. And obviously, there's a lack of congruency between the CCP mandated dates by which market participants must finalize elections to offload discounting risk. Swap compensation may create confusion or perceived advantages for certain market participants. And major differences between the CCP plans may create significant operational and market risk for participants over the discounting transition period. In order to help mitigate these issues, the subcommittee decided on 3 guiding insights that market participants should consider as they approach the October transition. First, enhanced education regarding the discounting transition is needed for all parties involved. And this is broad communication among all market participants and their role in this transition to ensure that everyone is armed with the same information available to ensure the most seamless transition as possible. 2, risk mitigation strategies ahead of discounting transition should be considered. Examples include trade compression and recouponing, or to reduce the notional size of things that are going to be going through this process in advance and make sure that people are taking those considerations into their process. Internal preparation and proactive engagement by all impacted stakeholders in industry preparations is absolutely critical to produce a positive outcome for the market as we go through this transition. Turning to page 6. To take this all a step further, the subcommittee has provided actionable recommendations for different types of market participants broken down between CCPs, FCMs, buy-side firms, and regulators. All the recommendations summarized on page 6 of our report attempt to provide next steps that market participants can take to better improve education, risk management, and internal preparation in line with the guiding insights that we just laid out. For the broader regulatory community in particular, we arrived at 3 recommendations to be considered as market participants work on their preparations. First, consider implications of Part 43 and other global real-time public reporting requirements for discounting swaps, risk swaps, vis-a-vis potential concerns that broader market transparency into auction portfolios could disincentivize aggressive bidding and therefore potential benefits of the auctions. Also consider implications of reporting or not reporting on transactions that are purely intended to give effect to cash compensation payment. Next, to confirm treatment and consider relief from tax and accounting implications of pre-hedging auction-related exposures. Also to consider other areas for no action or interpretive relief that will facilitate the discounting transition, potentially including relief in the uncleared market for swaptions and amendments to credit support annexes as proposed by the ARC in its June 16th letter to the Division of Swap Dealer and Intermediary Oversight. The ARC also looks to continue its active dialogue with the Commission and staff as we work collaboratively to fine-tune existing relief and identify new areas for relief that will help to facilitate the adoption of the ISDA protocol and voluntary conversions. The ARC's most recent filing underscores the continuing collaborative work with the Commission and staff. We look forward to sharing the full report with the broader market today, as we believe it will provide important guidance to be considered as every firm plans for this critical transition in October. It cannot be forgotten that the CCP discounting transition is a fundamental part of the ARC's PACE transition plan and will ultimately have a significant positive impact on the adoption of SOFR in the derivatives markets. However, this event does not come without certain risks, and it is important that we help provide the clarity needed by market participants to prepare for these risks. At this time, we will hope to pass back to Nadia, and we will welcome any feedback or questions from the MRAC on our tabletop exercise and our recommendations. The MRAC and the CFTC's guidance has been very helpful to our work thus far, and we look forward to further collaboration with this group today and in the future. And once again, I'd like to thank Commissioner Benham, Alicia Lewis, Nadia Zakir, you all at the MRAC for the opportunity to do this, to provide this service through our tabletop. And this tabletop could not have been a success without the integral work of Bob Wasserman from the CFTC, who served as our facilitator. So now I'd like to open the discussion for feedback and questions. Thank you.
Thank you, Tom. At this time, I'd like to open the floor to questions and comments from the MRAC membership on the subcommittee's report and recommendation. As a reminder, directions on how to ask a question or make a comment can be found in your meeting instructions. Tom, to start, I'd like to throw out a question for you. Given your role on the ARC and based on your discussions within the industry, do you believe that the industry's LIBOR transition efforts have been impacted at all by the recent developments and challenges around COVID-19?
Thank you, Nadia. I would say that when we approach these challenges, and I think like every organization, I say from the ARC's perspective and broadly across the industry, I think we have all been, pleased with the fact that even in a work-from-home environment, we have been able to actually navigate these challenges. And I can report from both the work that this subcommittee has done, which has been, frequent meetings and high attendance and great participation. That seems to be the model. And at the ARC, we ended up, because we moved virtually, doubling our meetings and moving forward. So I think as we heard from Governor Bailey, President Williams earlier this week, I think that there's been, I think we are all very optimistic that the work has continued in spite of the challenges of COVID. And of course, in everything that we've done, we've tried to be extremely aware and respectful of the challenges that every organization is facing. But at this point, when we look across the groups that we've been interacting with, it appears that because of the deadline and the work that needs to happen between now and then, we have not seen, in any large degree, resources being shifted away from this work. And I really believe that as we've approached, once we crossed into the year point and began really looking at some of the financial consequences that we see on the near-term horizon, whether it be the ISDA protocol, the CCP conversion, I do believe that the industry very broadly has continued to do this work in earnest, and in many cases have actually redoubled their efforts in spite of the challenges. So I think we're all really pleased with what we've been able to accomplish in this virtual setting. But I think as you mentioned earlier, I think it's difficult to get this work done, but I would have to say that these groups have adjusted very, very well, and I think we're well on track. And I would also add that I think based on everything we've heard over the last several weeks today from the Commission and across the official sector, it's very clear, I think, that we have now turned an important corner, and we're using our forward momentum to actually push this right to the deadline to ensure that we can have the most seamless transition possible.
Okay, great. Thank you, Tom. That's very helpful. I'd like to recognize Sujata Srinivasan from Goldman Sachs.
Thank you so much, Nadia. Thank you, Commissioner Benham, for the opportunity to serve on the committee, and to the staff for the warm welcome to MRAC, in particular to Alicia Lewis. Tom, thank you so much for this presentation, and to the subcommittee for the critically important work on this. I know that one thing that is important is a successful protocol in order to have a smooth transition. I understand that the ARC has been in discussions with the CFTC to get some relief that from what I understand, it's pretty critical for people to feel comfortable adhering to the protocol. Am I right on that? Would you be able to give us an update on that?
Yes, you are, and thank you for bringing this up. So from the perspective of the ARC, we appreciate the Commission and the staff's continued engagement on a host of these regulatory matters. And as we mentioned in our presentation, that the dialogue between the ARC and the CFTC and all these groups has been extremely productive and constructive over the period. The ARC looks to continue to keep that active dialogue going with the Commission and staff as we work to fine-tune existing relief and identify new areas of relief that will facilitate the adoption of the ISDA protocol and really voluntary conversions, which we think are of growing importance as we approach the deadline. More specifically, the ARC, we appreciate the robust dialogue to address several follow-on requests relating to the relief already granted by DCR, DSIO, and DMO last fall. So to answer your question, to this end, we appreciate the staff's consideration of the ARC's most recent request, which went out yesterday, which addresses a variety of issues critical and immediate importance to swap dealers and their counterparties as they seek to, get this smooth and orderly transition from IBORs and to other risk-free reference rates. So it's sort of listed out here, the DCR expand the relief from mandatory clearing provided in its previous letter to include all rates for fallback amendments as contemplated by the ISDA 2020 IBOR fallback protocol, which we hope which will be published shortly. All divisions provide consistent relief that allow IBOR transition mechanisms to effectively accommodate differences between market conventions for impaired reference rates and their respective replacements. And DCR and DSIO clarify and adjust the relief currently available to end users to improve the availability of that relief for end users. So once again, I think, thank you for bringing this up. We thank the Commission for their efforts to date and their willingness to continue to engage productively as we further the goal of a smooth transition. I think that the work that we've seen during this time, and certainly from the perspective of the ARC and from this interest rate reform subcommittee, that the dialogue has been great. We really see that there is a clear message that removing obstacles to transition sits as a high priority. We appreciate the opportunity to present these things, and we look forward to getting that dialogue done because these are important considerations. And as has been mentioned at the top of the meeting, signing up to the ISDA protocol is going to be an important milestone for everyone in the market to really mitigate a lot of the legacy risk that's out there. So thank you for the question, and I hope that was a good answer.
Thank you.
I'd like to recognize Stephen Berger from Citadel.
Thank you. First off, I'd like to commend the excellent work of the subcommittee and the high quality of the tabletop exercise and today's report. Nevertheless, I do want to urge further scrutiny of one suggestion, which is that post-trade transparency should be lifted with respect to the upcoming auctions, which one CCP, though not both, has indicated that they will request. I believe that the transition to SOFR is predicated upon the need for a more transparent benchmark, and that same principle of transparency should apply to the transition steps we're taking as well. I'll note that there's going to be an active secondary market in the same basis swaps subject to post-trade transparency, both before, during, and after the auction. And so that raises concerns about information asymmetries if some of the activity is kept dark while some of it's lit. And I'd also note that an exemption from post-trade transparency is notably not contemplated for CCP's default management auctions, which are the sort of closest parallel I could think of. So it's just one area that I think needs some more scrutiny before we proceed down that path. Thank you.
Thank you, Stephen. And I do think that, one of the key pieces of this is to lay things out that we think can, remove some barriers, but obviously there's other considerations, and thank you for that feedback.
MRAC members, since there are no further questions, is there a motion for the MRAC to adopt the subcommittee's report and recommend to the Commission that it consider adopting the report's recommendations? The Chair recognizes Annette Hunter from the Federal Home Loan Bank of Atlanta.
Thank you, Nadia. I move that the MRAC adopt the interest rate reform subcommittee's report to recommend to the Commission that it consider adopting the report's recommendations.
Thank you, Annette. Is there a second?
This is Jim Shanahan from CoBank, and I provide a second.
Thank you. The chair recognizes Jim Shanahan's second. It has been moved and properly seconded that the MRAC adopt the subcommittee's report and recommend to the Commission that it consider adopting the report's recommendations. We will now take a vote on the motion. As a point of order, a simple majority vote is necessary for the motion to pass. I will turn it over to Alicia to conduct a roll call vote.
Before we start with the roll, I just wanted to make sure that those MRAC members that we could not get on the record earlier, we get them on now. Dick Berner, please unmute yourself. Peter Borish.
Present, thank you.
Derek Kleinbauer. Eileen Kiley.
Good morning, Alicia. Hopefully you can hear me this time.
Got you, Eileen. Robert Mangrelli.
Good morning, Alicia. Hopefully you can hear me as well this time.
Dale Michaels.
I'm here, Alicia. Thank you.
Marcus Stanley. Marcus Stanley. Janine Tramontana. All right. So, committee members, when I call your name, please indicate your agreement with aye, disagreement with nay, or indicate abstain if you're abstaining from the vote. Please remember to unmute your line to indicate your vote and to remute your line once you finish voting. Salman Benai.
Aye.
Stephen Berger.
Aye.
Lee Betzel.
Aye.
DeBorish.
Aye.
Vish Chatterjee.
Aye.
Alicia Crichton.
Aye.
Shelley Goodwin.
Abstain.
Matthias Froelich.
Aye.
Graham Harper.
Aye.
Frank Hayden.
Aye.
Lindsay Hopkins.
Aye.
Annette Hunter.
Aye.
Dimitri Caruso.
Aye.
Eileen Kiley.
Aye.
Derek Kleinbauer. Laura Klemper.
Aye.
Rob Mangrelli.
Aye.
Kevin McClear.
Abstain.
Dennis McLaughlin.
Aye.
Craig Messinger.
Aye.
Dale Michaels.
Aye.
John Murphy.
Aye.
Sam Priyadashi.
Aye.
Jonathan Rafe.
Aye.
Marnie Rosenberg.
Aye.
Jim Shanahan.
Aye.
Lisa Shemme.
Aye.
Betty Simpkins.
Aye.
Tyson Slocum.
Abstain.
Sujatha Srinivasan.
Aye.
Marcus Stanley. Susie White. Susie White. Scott Zucker.
Aye.
Give me one moment and I'll provide you with the tally, Madam Chair. Madam Chair, you have 27 yes votes, 0 no votes, and 3 abstentions.
Thank you. The ayes have it and the motion has passed. The report and recommendations of the Interest Rate Benchmark Reform Subcommittee have been approved by the MRAC and will be submitted to the Commission for consideration. The next item on the agenda is the report of the Climate-Related Market Risk Subcommittee. As a reminder, we will be taking questions and comments at the end of the report. Bob Litterman is the chair of this subcommittee. Bob, please begin.
Thank you. Can you hear me?
Yes, we can.
Great. When Commissioner Benham and I first talked about my presenting to the Market Risk Advisory Committee today, we hoped that it would be in person and I would be able to deliver the Climate-Related Market Risk Subcommittee report on the managing climate risk in the U.S. financial system. Sadly, neither of these goals came to pass. The COVID-19 pandemic, which prevents us from meeting in person, has also slowed us down a bit, and we are still in the process of finalizing the report. Nonetheless, I want to assure you today that the subcommittee has been working diligently, productively, cohesively, and collaboratively to produce a report that we hope you will find to be a comprehensive roadmap for managing the growing climate-related risk facing the financial markets, their participants, and their regulators. And although the report is not finalized and I cannot get into specifics, I can assure you that the subcommittee has made excellent progress, and our report will contain recommendations that hopefully can play an important role in guiding the climate response of the U.S. financial community. Let me once again express my deep appreciation to the Commission for creating the Climate-Related Market Risk Subcommittee. Commissioner Benham and his Chief of Staff, David Gillers, brought together an incredibly talented and experienced group of professionals who, without compensation, put in hundreds, if not thousands, of hours of work. By way of context, let me also note that while this report has been presented to the U.S. Commodity Futures Trading Commission, while it will be presented to the U.S. Commodity Futures Trading Commission, we have been given a broad mandate. The objective is to provide an analysis and recommendations regarding the existing and emerging risks that climate change poses for the soundness and stability of the U.S. financial system. The report considers the risk of climate change impacts, such as sea level rise, extreme weather events, and rising temperatures, on economic activity and financial markets. It also takes into account the risks posed to the U.S. financial system by shifts in policy, technology, and consumer preferences, shifts that will be necessary to stabilize concentrations of greenhouse gases and reduce the risk of the most damaging impacts of climate change. Importantly, the report should help inform ongoing and future policy debates in the U.S. Congress and state legislatures, particularly since climate change will remain a matter of growing legislative interest. Finally, the report should be of interest to the American public, whom the recommendations in this report ultimately seek to serve by enabling the country to better manage one of the most significant threats facing our country. Over the past decade, financial regulators, business leaders, and legislatures around the world have embraced the need for better managed climate-related financial and market risks and recognized the urgency of meeting the challenge. Many countries have adopted legislation, guidance, and other initiatives to advance this goal. In addition, myriad international initiatives, working groups, task forces, coalitions, and other efforts have emerged to facilitate collaborative solutions and to accelerate learning and information exchange. The U.S. has been involved in and has even led some of these international efforts, but it is noticeably absent in others. As the world's largest economy and second largest emitter of greenhouse gases, U.S. engagement in and leadership of these initiatives remains essential and in the best interest of the nation, particularly since neither climate change nor financial crises respect national boundaries. At the same time, managing climate-related financial risks requires paying close attention to the unique circumstances of the United States. That includes the idiosyncrasies of our complex system of financial regulation, as well as the policy space defined by existing legislation and suggested by proposed legislation. It also must consider the central role that the private sector plays in our financial system and the importance of consultation and collaboration between the private and public sectors in the design of new policies. Finally, it is worth noting two interrelated challenges. One is how to safeguard the soundness and stability of the financial system in the face of climate change. The main goal here is to manage climate risk responsibly in order to protect the system's ability to serve the American public, to support economic activity and entrepreneurship, and to safeguard the assets of millions of savers, retirees, institutions, and businesses. The second challenge involves how the financial system can facilitate the transition to a low-carbon, climate-resilient economy. Central to this challenge is identifying ways through which financial markets and institutions can channel significant amounts of additional capital towards sustainable investments and net zero activities, including low-carbon and renewable energy, energy efficiency, other low-carbon technologies for transportation, industry, and agriculture, and resilience against climate impacts. A stable and well-functioning financial system is incompatible with a world of unmitigated climate change. Such a world would be too chaotic and racked by frequent and devastating shocks to sustain the fundamental conditions on which our financial system is built. Promoting the transition to a net zero emissions economy and safeguarding financial stability are consistent, mutually reinforcing objectives. Let me now briefly describe the process that we followed to produce our report. We began with two very productive in-person meetings as a subcommittee in November and December of last year, one in the CFTC offices in Washington, D.C., and one in the CFTC offices in New York City. We were considering a third in-person meeting when the coronavirus caused us to start operating virtually. I remember quite vividly sitting around the table in our first meeting as we introduced ourselves and talked about the organizations which we represented and the expertise that we each brought. Working with this group and learning from them has been a truly gratifying experience. At those two in-person meetings last year, we quickly agreed on the outline of the report, formed work streams around the major topics, and found members who were willing to lead or, in most cases, co-lead the various groups. Members volunteered to serve on one or more work streams, and as we moved forward, all members participated and contributed to the discussions and the writing process. Although I've been involved in financial risk management for over 3 decades, climate risk is different in several respects from the usual market and credit risks that we in the financial markets usually focus on. Unlike most financial risks, in which market participants have a long history from which to learn, we do not have much experience dealing with climate risks. In dealing with financial market risk, we often focus on extreme but plausible scenarios over relatively short periods of time, and we are guided by our historical experience. The financial impacts of climate change, on the other hand, are recent and to date have been relatively small, but are expected to grow significantly over time. Our grandchildren will grow up in a world in which each decade is expected to be warmer than the last, a world in which sea levels will continue to rise, extreme weather events will increase, wildfires will grow in size and frequency, human health will be challenged by increasing warming, and global ecosystems will be put under stress. Scientists have warned that it is very plausible that we could soon cross a tipping point after which impacts could grow in a nonlinear fashion, leading to catastrophic outcomes. We are doing an experiment of unprecedented scale on a complex system with little historical experience to guide our understanding of what an extreme but plausible outcome looks like. Today, climate change is just starting to have impacts on valuations of securities and creditworthiness of market participants. And just about the only thing we can be confident of is that these impacts will grow over time. Thus, the data and analytic models needed to address climate change are just beginning to be developed. It is important to acknowledge that our understanding of the complex issues associated with climate change impacts is only rudimentary. The bottom line of this report is that the U.S. financial regulators must recognize that climate change poses serious emerging risks to the U.S. financial system, and they should move urgently and decisively to better measure, understand, and address these risks. We anticipate the report to be complete either in August or at the very beginning of September. Thank you. That concludes my report.
Thank you, Bob. We'll now open the floor to questions and comments from the membership on the report. As a reminder to members, directions on how to ask a question or make a comment can be found in your meeting instructions. And as we wait for those questions, Bob, let me throw out the first question here. As you know, the general theme of today's meeting centers around the impact of COVID on our markets. And while I recognize that you're not able to share the discussions of the subcommittee, can you share your thoughts on the impact of COVID or the impact of COVID as it pertains to climate-related financial risk?
Well, thank you for this that question. As the report is being finalized, as you know, we're in the midst of a pandemic with 140,000 deaths already and severe economic impacts. And of course, there are many differences between the global pandemic, which is a sudden health crisis that is expected to have impacts of perhaps a few years, and climate change, which is a global threat that will play out over decades with potentially permanent consequences. And in that context, the short-term reduction in emissions associated with the pandemic is but a minor blip. But both the pandemic and climate change are similar in one crucial dimension. They are both global risk management challenges, and science clearly indicates that the cost of delay in responding to the risk can be devastating. A recent study from Columbia University suggests that in the case of the virus, delaying social distancing by 1 week in the United States doubled the number of deaths. Similarly, every year of delay in the policy response to climate change will lead to a higher mean global temperature increases down the road and to greater probability of irreversible and catastrophic damages. Hopefully, this obvious parallel will help move forward in time the inevitable global policy response to climate change, which is the creation of appropriate incentives to reduce emissions.
Thank you, Bob. If there are no questions or comments on the climate-related Market Risk Subcommittee report, we will move on to the report of the Market Structure Subcommittee. Lisa Shemy and Stephen Berger are the co-chairs. Lisa and Stephen, I'll turn it over to you.
Thanks very much, Nadia. This is Lisa Shemy. I am an Associate General Counsel at SIBO Global Markets and serve as Chief Legal Officer of our FX trading venue, SIBO FX Markets and SIBO staff. I am speaking on behalf of Stephen and myself and wanted to start by, of course, thanking again Commissioner Benham for giving us the opportunity to lead what we hope will be a very impactful session of the Market Structure Subcommittee. I also wanted to thank Alicia Lewis for all of her help in planning today's event, as well as Nadia Zakir for all of her guidance. And we are very excited to present our interim report on the activities of the Market Structure Subcommittee. In particular, I wanted to thank all of the members of our subcommittee for the work that they've done and contributed so far, and for the future work that we hope to conduct on the important issues that we've identified for discussion. I did want to start by taking Commissioner Benham's cue and acknowledging today's 10-year anniversary of Dodd-Frank, which threw me for a loop when he said it, or as we used to call it very soon after its enactment, we used to call it the Full Employment for Lawyers Act. So I'm sure many people here, lawyers and non-lawyers alike, think of it in the same way. But of course, it has changed many of our careers and created tremendous opportunity to learn and study and propose changes to market structure in the derivatives market. So in presenting our report for today's MRAC meeting, we wanted to cycle back to the report that we presented in the December meeting, which feels like a generation ago already. as a reminder, the Market Structure Subcommittee, prior to the December MRAC meeting, identified three potential rubrics and topics for consideration during our meetings, and we put them under three broad categories: trading, clearing, and reporting. Following that meeting, the subcommittee went ahead and formed working groups to explore the issues that we had identified within each of those areas in greater detail and to work towards developing forward-looking recommendations for the Commission to consider. The working groups, together with the list of the issues that we discussed, are listed on an annex to our report that hopefully most of you can see in your materials. In the last few months, starting in January of this year, we met with all of our sub-working groups, and over the course of several meetings, we worked hard to try to whittle down the very long list of interesting topics to be able to hone in on issues that we hope we could be more impactful on. And following several meetings, we came to an agreement to focus on topics relating to the swap dealer landscape and the made available to trade MAT process. A couple of months ago, as we began to turn our focus towards today's meeting, Stephen and I discussed the potential of pivoting away from that original plan, at least with regard to timing, and instead to try to focus on the effects of the market conditions resulting from or following the onset of the current pandemic. And we decided with the Commission's support, as always, to redirect our near-term efforts to examine how markets actually performed and how market structure functioned during this period of significant stress. So what we are hopeful to do in today's presentations and discussions is to hope to inform the Commission on how the markets actually did perform, the markets under the Commission's supervision and otherwise, and focus on whether there may be any market structure-related issues that emerged during this period of stress that may warrant some attention. What we've done then is invited a representative from the firm of Claris Financial Technology, who will be presenting some data on market performance during the period of volatility. The second presentation and the second and third presentations will be given by representatives of each of Bloomberg and TradeWeb, who will provide their perspectives on this period, in particular focusing on the interest rate derivatives space. Following those presentations, Stephen and I will jump in and moderate a discussion among MEMRAC members, and certainly invite all of you to raise your hand if you would like to bring up issues. But we have identified some of our members who we've discussed certain topics that we will call upon them to share, and hoping to have a little bit more emphasis turning from the swap side towards as well the futures and CCP side of the discussion. Following our moderated discussion and following today's MRAC meeting, the subcommittee is planning to revert back to the original work that I highlighted earlier to further discuss and study recommendations relating to the principal areas that we've identified to focus on, i.e. the swap dealer landscape and the MAT process, and hope to have substantive and impactful and actionable recommendations to present to the committee as soon as the next meeting of the MRAC. So we're very excited to lead this discussion, and again are very grateful for the opportunity to participate in this important time in our market. Nadia, I can hand it back to you.
Thank you, Lisa. We'll now open the floor to questions and comments from the membership on this report. As a reminder, directions on how to ask a question or make a comment can be found in your meeting instructions. And Lisa, let me ask a follow-up question here to your report, and thank you again for all of your work in chairing, along with Stephen, this important subcommittee. At our prior MRAC meeting, a number of topics were identified as potential focus areas for the Market Structure Subcommittee. Can you provide some more information on how and why the subcommittee selected the two topics of swap dealer landscape and the MAT process as areas of focus.
Sure. Thanks, Nadia. So to start, as I mentioned, we did have a very broad and diverse list of issues that we discussed among the working groups. Certainly over the scope of several calls, started to hone in on these two broader topics that seem to impact the majority of the firms, of our member firms, and the comments that we were receiving. The swap dealer landscape in particular was one where we considered there to be a lot of issues under that sort of general sub-rubric that we thought we really could discuss and could come up with recommendations, in particular having to do with such issues that we've been discussing for what seems like a generation now, issues like the concentration of the swap dealers that are active in the market and whether there is anything that could be done to broaden the scope of swap dealers that are registering and active in trading. How could we be pointing to that concentration issue potentially through discussion on the floor trader exemption, where there's been, very hopefully impactful changes from the commission over the last year, but where we wonder if there could be additional focus in order to allow for more market participants to register as swap dealers. And even looking at things like the swap definition itself or the swap dealer de minimis requirements, again, with the focus on trying to broaden concentration or broaden the number of swap dealers that are registering and that are active in the market. I'll turn it over to Stephen as well to give some thoughts on the MAT process and why we came to that conclusion too.
Thank you, Lisa. So with respect to the made available to trade process, I think, there's a universally accepted fact that there haven't been any new made available to trade filings since late 2013, which it begs the question of why that hasn't occurred. So that in and of itself seemed worthy of exploration. At the same time, there have been a number of proposals put forward by an array of market participants in the interim about how the made available to trade process could be revised. Back in July of 2015, there was a DMO staff roundtable where there were a lot of excellent ideas discussed. And many trade associations and market participants also provided recommendations in response to the CFTC's proposed CEF rule amendments that were put forward back in the fall of 2018. So there have been a lot of recommendations put out there, and I think that, but no sort of, I think, consensus path forward has yet to emerge. So the hope of the subcommittee is that we could, spend time going through all the recommendations that have been put out there, and try to come up with a path forward here. I think the areas that will be in focus are first of all the criteria one uses when determining whether a swap is made available to trade. So the current statutory language and certain rule language, sets out the quote unquote 6-factor test. So I think reevaluating those factors will be an area of focus. The second area of focus will be on who can initiate a MAT filing. Currently, it's contemplated that it's the CEFs themselves who have the authority and responsibility to put forward MAT filings, and there's open questions, and there have been recommendations that ability to initiate should rest perhaps with others instead of or in addition to the CEFs themselves, be that market participants or the commission. And then the third area I think that will be in focus is what's the process for public comment when MAT filings come forward. What's the standard for approving them or rejecting them? So that's another area where there's been some both uncertainty and a desire to put forward recommendations. So I think the time is right to move forward on this. I think as the market continues to evolve, we do need to make sure that we have a MAT process that is, can appropriately adapt to evolving liquidity conditions, the introduction of new products, the retirement of existing contracts, so that we can continue to move forward positively with respect to the universe of products that trade on CEFs.
Thank you, Stephen. Obviously, we as MRAC really do look forward to continuing to work on this with the subcommittee as well as reviewing the reports and kind of the results of that report. If there are no questions or comments on the Market Structure Subcommittee report, let's turn to our first panel of the day. The first panel is titled Market Function and Performance During the Early Months of COVID-19. We will have presentations from Chris Barnes of Claris Financial Technology, who will discuss overall swap market activity and COVID-19. Chris, are you on the line?
Certainly am. Yes. Hello, everyone.
Thank you. We'll also have a presentation from Adam Peralta, Head of Rates, Electronic Trading at Bloomberg LP, who will discuss market volatility and interest rate swap trading on Bloomberg CEF. Adam, are you on the line?
Yes, I am.
Thank you. And we'll have Elizabeth Kirby, Head of Rates, Product, and Strategy at TradeWeb, who will discuss how TradeWeb's platforms performed during the early months of the pandemic. Elizabeth, are you on the line?
Yes, I'm here.
Great. After the presentations, we will move into the moderated discussion. At that time, we will take questions and any comments on the presentation. As a reminder, your meeting instructions have information on how to ask a question or make a comment. Chris, I will turn it over to you.
Thanks very much, and thank you all for the opportunity to speak today. My name is Chris Barnes. I'm the SVP for Europe at Claris Financial Technology. Probably makes sense in case people haven't heard of Claris to explain exactly who we are. We're a provider of analytics, data, and research, mainly with a focus on derivatives markets, and specifically we focus a lot on OTC rates. We have a very widely read blog on our website, clarisft.com. I would encourage you all to check out the research there if you haven't done so previously. And it seems very apt that it's because I don't think it's an exaggeration to say that Claris probably wouldn't exist if it wasn't for Dodd-Frank. We are very, very active consumers of all transparency data for derivatives markets. And generally speaking, what we do is we take that transparency data and we make data products from it. And so our blog, I've written nearly 300 blogs now in the 6 years I've been there at Claris. Our blogs are very much based on that transparency data. So if we could just move forward, Alicia, to the next slide. What I'll start with is a very broad overview of what we saw happen as a result of the COVID-19 related volatility in the market in terms of global volumes. So the data we're looking at here is looking at all interest rate derivatives cleared at all CCPs globally. So this isn't just Dodd-Frank data, this is the whole global market. What we saw in March 2020 across the major 6 currencies here, across all those rates derivatives products, was an all-time record in notional volumes. Now, this is really, really interesting chart because it's very unusual, but it wasn't actually a record month for US dollar swaps. And it wasn't a record month for euros. And it wasn't a record month for yen or sterling nor Aussie. However, when you put them all together, we see a record month. And I think that probably more than any other slide I've got in this deck really presents the global nature of this shock. This really affected everything, everywhere. And so in light of that, what is particularly impressive from a market structure perspective is how the whole clearing infrastructure across every single conceivable aspect was able to scale up so quickly to meet unprecedented demand, really, unprecedented volumes across all of the currencies at the same time. And that really, really speaks very, very positively for the resiliency we saw in the cleared markets. Now, in terms of talking about clearing, the chart doesn't show it, but what we also saw was that market participants actively continued to choose to clear their risk. They actively chose to trade at CCPs. Now, if we look at notional, if we look at the risk traded, the DVO1, it doesn't really matter. What we saw in March 2020 was that 96
It sounds like Chris's line is dropped. Let's give him maybe just a minute to see if he can dial back in. Perhaps in the interest of time, while Chris is dialing back in, it may make sense for us to move to Adam Peralta's presentation. Adam, are you on the line?
I am.
Okay, great. Can we please cue the relevant presentation, Alicia? Adam, please begin.
Great. Good morning. My name is Adam Peralta, and I'm responsible for the global rates electronic trading business and product development at Bloomberg. I would like to thank the MRAC for the invitation and opportunity to speak about this very important topic. At Bloomberg and Bloomberg staff, we welcome the consistent dialogue and look forward to continued conversations surrounding this topic and more to come in the future. Next slide, please. Today, I'm going to focus my discussion around the March 2020 market volatility and the overall performance of BSEF, specifically related to risk transfers across the platform. This past March, as we all observed, the global markets experienced unexpected volatility, resulting in an overall increase in trading volumes. Likewise, BSEF experienced year-to-date highs in both gross notional and DVO1 executed on the platform. As market volatility increases, participants begin to question their ability to access liquidity and, moreover, their ability to transfer risk at any given point in time during the day. Despite the extreme market volatility, BSEF observed an increase in hit rate as DVO1 increased per trade, indicating BSEF participants were able to effectively manage and transfer risk over the platform. As such, and for purposes of this presentation, we chose to narrow our focus to the following: overall March 2020 market volatility compared to March of 2019, overall DVO1 transacted, and overall system performance on BSEF. We chose to exclude compression and list trades from our analysis, as those trades tend to inflate overall notional values when looking at real risk transferred in the market. Next slide, please. Taking a look at March 2020 market volatility more closely, what you see is a chart using the yield vol US index, the swaptions market, as a gauge for interest rate volatility. March 2020 experienced a dramatic increase, as the chart as compared to March 2019. The blue line, I think it's obvious based on this pattern, is the volatility experienced in March of this year, where the purple line is March of 2019. This resulted in an increase of 116% in notional compared to March of last year, and DV01 on BSEF, 142% increase in tickets compared to March of last year on BSEF as well. Additionally, RFQ remained the preferred execution method for our market participants to trade. We did notice that the number of liquidity providers that were placed in competition increased during these volatile times in the market. Next slide, please. Taking a look at risk transfers in the market, we thought it would be useful to understand performance as it relates to the risk being transferred over the CEF. And in doing so, we decided to illustrate this by charting DV01 against trade state. On the y-axis is DV01 bucketed in increments of 10,000, 25,000, and 100,000 plus. On the x-axis is the trade state. Accepted indicates all executed trades occurring on the system. Expired means trades that expired, did not trade. Passed are trades where the taker passed. And rejected are trades where the liquidity provider rejected an inquiry. As you can see by the top green line, as DV01 increased, accepted trades increased, implying a strong platform performance for large-sized trades done over BSEF. It's important to note that trade rejects during this time period were minimal. However, BSEF did observe a slight increase in past trades, which is expected during uncertain market conditions. Next slide, please. Here I'd like to step through some basic performance metrics that we pay attention to at BSEF. Overall, from a system standpoint, Bloomberg CEF performed well and experienced year-to-date highs for trade count and processing trade requests, illustrating overall system resiliency in times of high volume and high demand placed on the system. The top chart shows a dramatic increase in trade requests processed, in line with the increase of volatility we observed on the second slide. Hello? Am I back in?
Hi, Adam, you're on. Continue.
Okay, good. I just heard radio for a moment. So the second chart on this slide is a close-up of the peak volume illustrated in the above chart, narrowing in on the processing rate, which I found to be quite interesting. So the processing rate here indicates all trades that were submitted across the platform, and that was a 400% increase, processing over 2,000 trades per minute during the course of this, over the course of just one day. Next slide, please. To conclude, March represented unprecedented market volatility in recent times, testing the framework of execution, clearing, and trade reporting. BSEF believes that the current swaps market structure performed well under stress, evidenced by the participants' ability to transact during periods of extreme volatility. Additionally, BSEF values the consistent dialogue with market participants, industry groups like ISDA, and continued engagement with the CFTC during these times of market stress. I'd like to thank everyone for your time today, and please do not hesitate to reach out to me if you would like to continue a discussion around this topic or anything related to BSEF generally. Thank you.
Thank you, Adam. Let me see if Chris Barnes is back on the line here, and maybe we can continue his presentation. Chris, are you on? Okay. Why don't we move to Elizabeth Kirby? Elizabeth, let me turn the floor over to you.
Great, thank you. My name is Elizabeth Kirby. I'm the head of rates product and strategy at TradeWeb. I'd like to thank the committee for inviting us to present here today on the impact of the COVID crisis on our derivatives marketplace. Could I just ask for the slides to be, let me see. There we go, okay. Would you mind moving to the next slide, please? Great. So I wanted to take a step back and provide a little bit of context. I know that some of the members of the committee may be more involved with swap markets than others. So firstly, for those of you who might be less familiar with Tradeweb, as a firm, our foundation lies in the rates markets. Our company started in 1998 as an electronic trading platform for U.S. Treasuries, and we introduced derivatives trading in 2005. We currently operate two SEFs, TWSEF and DWSEF, which offer different trading protocols and serve different segments of the marketplace. Would you move to the next slide, please? Across these two SEFs, we offer a number of different trading protocols. And this is an interesting distinction relative to futures or some of the other asset classes under CFTC jurisdiction, as much as the trading activity does not take place on an exchange or an exchange-like venue. Today's presentation is going to focus largely on TWSEF, which serves the institutional buy-side to sell-side marketplace. The dominant trading protocol on TWSEF is request for quote, or RFQ, which is a disclosed and bilaterally negotiated protocol in which the parties to the trade are known to each other prior to execution. As a result, some of the statistics that we are going to look at with respect to the health of the marketplace through the events of this past March will be somewhat unique to the RFQ protocol as markers of liquidity in the RFQ marketplace. Would you move to the next slide, please? So in 2005, we launched interest rate swap trading on Tradeweb. And then the trading mandate was introduced, as everybody knows, in 2014. We experienced something of an explosion of trading volume on the platform following the 2014 trading mandate as participants transitioned their business onto Tradeweb and other SEFs. What's interesting is while 2014 was a big bang, it was not the end of the story. So following some subsequent phasing in of package trades over the course of the next year or so after the introduction of that 2014 trading mandate, there's been no further expansion of the MAT list, as Stephen mentioned. However, we see here that the volumes transacted on Tradeweb and TWSEF continue to grow significantly. Some of that, as you can see by this light blue bar, is driven through some of the mandates coming out of Europe or other parts of the world. But the SEF contribution to the swap volumes on our platform continues to grow year over year, even into 2020. Would you move to the next slide, please? And so what we've seen and what this slide shows is that particularly in the past couple of years, Tradeweb platform growth has greatly outpaced the growth in the swap market overall. Next slide, please. So what is driving this trend? Interestingly, we see a continued migration of non-MAT or non-required swaps onto the platform. Market participants are finding that the trading efficiencies and the execution quality of trading on venue are such that there is significant voluntary migration of trading activity onto the SEF. And as you can see in the 2020 bar, this trend has not abated despite the challenges of 2020, specifically in March. Next slide, please. So as we've heard from the other panelists, there were record volumes in the swap market, and this was no different on Tradeweb. We saw record volumes across interest rate swaps and credit default swaps. We also saw record volumes in the Treasury market, which I will present here as sort of a basis of comparison to the derivatives markets, due both to the depth of liquidity in the Treasury market and the length of time that it has been traded electronically, and specifically traded electronically on Tradeweb. Next slide, please. So here, broken down on a weekly basis, you can see the breakdown of these record volumes as we progress from February into March and then subsequently April. Again, broken down, the Treasuries is that dark blue bar on the bottom, interest rate swaps, the light blue bar, and then credit default swaps are in gray. Next slide, please. So a trend that I think is very interesting through the volatility and sort of the constrained environment that we saw in March is a clear increase in block trades transacted on the platform. So again, block trades are trades above the size threshold that has been determined by the CFTC. And so these are swaps that can be transacted either on SEF via RFQ-to-1 or potentially RFQ in comp, or can be transacted off of the SEF via phone or chat and then subsequently processed through the SEF. It's interesting because during a time of potentially constrained liquidity, market participants were both willing and able to transact in large size during a time of crisis. What we saw is that for some of these trades, we saw participants becoming slightly less price sensitive as their focus shifted to the ability to move risk. But ultimately, I think what is borne out of this chart is that the platform held up very well, particularly in its ability to allow participants to move sizable amounts of risk, particularly during times of crisis. Next slide, please. These are some of the metrics that I was alluding to earlier that are somewhat specific to an RFQ market. And these metrics are hit rate and quote rate. You can see that for both of these metrics, and just quickly sort of describe what these represent. The quote rate is the rate at which dealers respond to requests for quote. That's the RFQ request for quote submitted by a client. So you can see that typically for most of our markets, these quote rates hovering between 90 and 100% during normal times. In times of crisis, these quote rates tend to fall a little bit. That may be as a result of certain liquidity providers not quoting certain trade requests, or it may be in certain cases simply that they are not quoting fast enough and the trade is completed before the quote can actually be received by the client. So you see that these do kind of dip during those early and mid weeks of March when we were sort of in the throes of this crisis. But again, what I think is very important to see here is how quickly they snap back to relatively normal levels. And again, I think that is a pretty strong indication of generally the health of the SEF marketplace and the way that the platform performed during this crisis. Similarly, you see a similar trend on the hit rate chart above, and the hit rate is sort of a similar metric, but looking at the customer side, the liquidity taker side, and what percentage of times they actually consummate the trade that they've sent in the request for quote for. But similarly, you see this sort of dip a little bit in that sort of mid-March timeframe, and then relatively quickly come back in line with what we consider to be more normal levels. Next slide, please. Again, looking at charting here, some additional markers of liquidity on the platform and health of the platform, bid-offer spreads. This is obviously sort of a traditional way to look at the liquidity in the market and generally sort of the health of the market. And we see a very similar thing, which is that certainly those spreads did gap wider in these periods of sort of heightened volatility or constrained liquidity, but once again, very quickly snapped back to a much more normal range. And even during those times in which the bid-offer spread had widened out, as I mentioned earlier, participants may have become slightly less price sensitive and willing to accept a wider bid-offer spread as long as they still had the ability to move sizable amounts of risk, which we saw that they did do. Next slide, please. So what conclusions can we draw? Obviously, this was a challenging time in March, but we observed market indicators of constrained liquidity, but not really market interruption. So participants continued to be able to trade on the SEF. They were able to trade, obviously, in larger volumes than they ever had before, and able to trade in large size on the platform. SEFs were flexible enough to absorb this type of modified client behavior, and so clients were able to transfer risk. We did, interestingly, to note, we have worked with the CFTC to provide data around all of these bid offer spreads and the metrics that we saw, such that the CFTC could continue in conversations with, with the marketplace and with groups such as ISDA on the events of March and, whether these SEF platforms operated as intended. So in conclusion, it's certainly our position that the market did behave as expected despite the challenges in the marketplace and the constrained liquidity that we saw through March. Thank you again for the opportunity to present today.
Thank you, Elizabeth. Why don't we turn to Chris Barnes. Chris, are you on the line?
I am on the line. I'm back. Sorry about that.
Okay, great. So before we turn it back over to you, why don't we cue the slides? Okay, great. Chris, I'll turn it back over to you to continue where we left off.
Thank you very much. So I was just in the middle of saying that the market participants continue to choose clearing. It doesn't really matter how you measure it, whether you measure it on notional or the amount of risk transacted. But about 96% of vanilla fixed float swaps were still cleared in March 2020. Now, that might not be such a surprise for these 6 major currencies highlighted, given there are clearing mandates in place. But as the current slide shows, market volumes across all other currencies as well, so excluding the 6 largest, also hit a record in clearing. Again, another way of reinforcing the sheer nature of the global shock the markets saw. What I also want to highlight on this particular slide is the sheer growth in volume that CCPs have seen in these smaller currencies. I think we're covering something like 14 currencies here, and this is a time span that covers only 3 years, and yet in those 3 years, global cleared volumes in these currencies alone have pretty much tripled. So it's really, really impressive to see how the clearing architecture has continued to scale up. Now, if we just move forward to the next slide, moving away from global data, which is taken from our CCP View product. What's really, really important in terms of Dodd-Frank post-trade transparency is that it gives us a picture at a transaction level for trades transacted. What that transaction level transparency allows us to do, and this is really important for a month like March 2020, is actually calculate the amount of risk that's trading. So rather than just looking at the notionals that are reported to SDRs, what we do at Clarus is we consume that data and we perform analysis on it, and we translate the notional into DV01, the discounted value of a basis point. What that tells us is how much risk is passing through the market, and it's not distorted by lots of short-dated, very high notional trades, which may be smaller in risk compared to a smaller notional long-dated trade. So what we saw in March 2020 was that it was also a record month in terms of the amount of risk reported to an SDR. What that means is that the record volumes we saw across the market, they were not just a result of short-dated large notional trades. Real risk, really large amounts of risk were effectively passing through the market. That's very unusual when all of the central banks are in play. Normally, when that happens, we see a lot of short-dated trades, but that doesn't necessarily mean that it's a record month for risk. Drilling in on particular markets, it was a record month in dollar IRS in terms of the amount of DV01 reported. And when we look at the sheer size of risk that went through compared to a typical month, which is pretty much a 12-month rolling average, we'd say. For March 2020 alone, we saw 90% more risk transacted. It's really, really impressive numbers. If we go to the next slide, what I think is really, really important about that record month in dollar IRS is exactly as the title says here, transparency worked. I think it's important to cast a light that US SDRs, US post-trade transparency for OTC rates derivatives is the only transparency regime across all of the jurisdictions, Europe, Asia, etc., that actually works, that actually gives market participants access to post-trade transparency and gives us a view of the market. What that means is that there is the possibility for dealers who have multiple entities who are active across multiple jurisdictions to actively trade in entities that do not report to US SDRs. So when we have a crisis, when we have volatile markets, there is a possibility that these dealers could intentionally move their trading activity away from these lit markets in the US. And I cannot stress enough that during March 2020, that is behavior that we did not see. Consistently, 45% of the global dollar IRS market was reported to US SDRs. That is entirely in keeping with historic averages. We calculate that average by taking our data set of cleared dollar IRS across all of the global CCPs, and we compare that to what is reported as cleared dollar IRS in the SDRs themselves. I think that's really, really important. I used to be a cross-currency swaps trader for 12 years, and that's a very, very liquidity-constrained market. Let's say it only trades periodically. And when I was trading that during the GFC from 2007 to 2009, that it was a constant fight whether those markets were actually functioning, whether there were prices, whether there was liquidity, whether it was possible for our customers to actually transact risk. And during March 2020, what post-trade transparency gave us as market participants were really, really clear signals that markets were not seizing up. They were not seizing up. They were continuing to trade. And what that does is it removes a lot of the rumors from the market. Back in 2008-9, there were always rumors floating around, irrespective of the product type, of something had traded in large size massively off market. With post-trade transparency, all the value in those rumors just disappears. And what is key from being able to use that transparency data in those volatile markets is that both price information and volume information is displayed. That allows us as market participants to really assess the value of the data, whether those prices are being traded at a consistent market size, and where large pockets of risk are moving as well. So I think that's a really important message that transparency worked during March 2020. You can just move on to the next slide, please. It's also worth noting, and I note that TradeWeb and Bloomberg have said this already, but I will go through this quickly, that CEFs during March 2020 worked extremely well. They actually worked so well that I struggled to fit 3 kind of meaningful slides that highlighted just how well they performed. We could really take any metric in terms of volume, products, et cetera, to really express just how well CEFs performed during March. So the kind of headlines and bullet points here are there was a record percentage of dollar IRS transacted on CEF in March 2020, reflecting how good March was, I think. If you look at April, it was a new record. 71% of dollar IRS was transacted on CEF in April. I don't think if market participants had had a bad experience with CEFs during all of the March volatility, they would have flooded back to CEFs in April. I think it really speaks to how people have had a good CEF experience during volatile markets. Now, interestingly, when you look at which market participants chose CEFs, the volume data very clearly states that it was the dealer to customer, the D2C market, that really saw a big increase in volumes traded during March. The combination of Bloomberg and TradeWeb during March hit a combined 75% market share across all currencies for all vanilla fixed float IRS. That was a high point for that market share split of D2C platforms. It's also worth noting that this wasn't in a shrinking CEF market, right? The outright volumes actually transacted on CEF were also at records, for example, for dollar IRS. So it's not as if the D2C community of CEFs captured a bigger portion of a shrinking pie. These were record outright volumes as well. And so everything has grown. It's just that the D2C area grew more in terms of volume than the D2D area. If we go to the next slide, and this really rings true with what Liz was just saying, what worked well for the D2C CEFs, and I think this is particularly interesting in terms of the recent consultation on block trading, is that a huge percentage of risk was traded as block trades on D2C CEFs. Now, there's a little bit of quirk of transparency in terms of how we know that, how we know this, but essentially only block trades are executed on Bloomberg and TradeWeb. And so we know from the combination of CEF reports and SDR reports that block trade volumes as a whole hit a record during March 2020. We also know from the CEF reporting and the transparency that the CEFs provide themselves that 43% of dollar IRS volume was transacted as a block. And that was a high amount for this year. Now again, block trading has continued to be popular even after all of the volatility we saw in March and beginning of April. It really, really suggests from the data that market participants have had a good experience. They've had a good experience of transacting blocks when times are tough. And so they've continued to do that even after the huge volatility we've seen. Now, finally, on the next slide, moving away a little bit from volumes alone, what post-trade transparency also allows us to do is look at prices. But of course, those prices don't operate in a vacuum. And there's always this kind of intellectual struggle we have as market participants to define exactly what market liquidity is. It's probably fair to say that market liquidity is a combination of volumes, but also price. We've concentrated almost exclusively on the previous slides in terms of what volumes have done. However, with the transaction level data provided as a result of Dodd-Frank, we can look at the prices transacted as well. Now, on the Clarus blog, we've run a whole series of blogs trying to look at this quite intricate measure of price volatility, which is called price dispersion. It's actually quite a simple measure. all it does is looks at the volume-weighted contribution of trades during the day to the overall average, the overall volume-weighted average price. As a kind of broad brush rule of thumb, if price dispersion increases, it suggests that maybe bid offers have increased, but it certainly suggests that there's a bigger gap in price between trades. And so it's used as kind of an analogy for liquidity. If price dispersion goes up, it's normally a negative sign for liquidity. Equally, what you could say in light of March 2020 is that we saw volumes going up and hitting records. Volumes can't hit records if there's no liquidity in a market. So another way of looking at the fact that price dispersion went up when the markets were exceptionally volatile is that the price to access that liquidity when markets were volatile was higher. And that's clearly what the chart shows. You know, there was a very concentrated period of probably about 20 trading days where price dispersion was very much higher compared to all of the previous 2020 and certainly compared to the period after. But it's also very evident that those pricing conditions returned to normality very, very quickly. Now, it's difficult to give, you know, an exact representation of what price dispersion is without going into all of the mathematical details. So I would just encourage people to have a look at the research out there, because it's a really, really interesting metric, I think. My final slide, we can just skip forward. Looks at uncleared markets. So I've exclusively looked at what has been cleared and what's transacted on the CEF so far. However, of course, we do have a whole other portion of the market, the uncleared markets. It's particularly of interest to me because I used to be a cross-currency swaps trader. Cross-currency swaps, along with swaptions, remain the two largest uncleared markets, certainly from a rates perspective. Now, if we look at cross-currency swaps, that is a direct measure of how people are raising dollar funding. And as we all know, dollar funding access was very much at the center of this crisis, was very much also at the center of the central bank responses to bringing market conditions under control. And so we saw central bank FX swaps opening up in unlimited amounts for the major currencies. We saw the uptake of those facilities hit levels never seen before. They were even higher than back in the 2008 crisis. And the uptake by the banks of those facilities for dollar funding was exceptionally quick. And in light of that, everybody expected there to be record volumes traded in cross-currency swaps. And yet when we go and analyze the SDR data for cross-currency swaps, we don't see a spike in volumes for March 2020. It's really surprising because it was short-dated dollar funds being offered by the central banks. You would expect that to filter down into the bilateral markets. You would expect those to be very large notional amounts. Therefore, you would expect to see a spike in notional amounts traded, and we do not see that in the data. Similarly, for the swaptions market, when all the central banks are in play, they're all cutting rates. Okay, it'll bring long-dated volatility down eventually, but that initial spike of activity should still result in a lot of short-dated, large notional trades being reported. We thoroughly expected to see all-time records in cross-currency swaps volumes and swaptions volumes. And the SDR data just doesn't show that. And that's really concerning. You know, and it really highlights to me how limited the transparency remains in these uncleared markets. Now, we haven't written any research on this yet, exactly because there isn't as much transparency in uncleared markets. So we don't know if market participants actively avoided trading out of SDR reporting entities. We don't know if volumes in these products were larger in Europe and Asia than normal, because we don't have post-trade transparency in those jurisdictions. We don't know whether market participants were trying to trade these, and yet the liquidity wasn't there. We don't know if the markets failed to scale. And equally, if that was the case and the failure to scale wasn't there, even though the demand for these products wasn't there, we don't know why. Was it that people were avoiding taking on more bilateral counterparty credit risk, or was it somehow a result of operational complexities which may come from the uncleared margin rules? We just don't know. And so I really feel like coming out of the market volatility, that should be a big focus for future research. Finally, I just wanted to highlight on the next slide, we have a widely read blog, clarisft.com. We cover aspects that are very much at the heart of market structure, clearing, transparency, and regulation. If there's any charts in here that are of particular interest, you will probably find them on the blog with a more in-depth description of the exact time series. On that note, I'll leave it there.
Thank you, Chris. Now we're going to move into the moderated portion of today's discussion on market functioning and performance during the recent market events surrounding COVID-19. And I'm going to turn it over to Lisa and Stephen to help moderate that session.
Thanks very much, Nadia, and thanks so much to the presenters who gave a great presentation to tee off the conversation that we hope to have among the market structure subcommittee members and the broader MRAC members on these important market structure issues. Just as a reminder, to the extent any member would like to ask a question or make a comment, please refer to the meeting instructions that Alicia had provided regarding how to ask questions or be recognized. And with that, we'll start with a few of our fellow MRAC members who have expressed some points that we thought may make sense to discuss following these great presentations. I'd like to start first with Sam Priardashi from Vanguard, and wondering, Sam, if you may be able to perhaps broaden this discussion, which was admittedly pretty swaps heavy, to touch on market functioning and performance in other classes, asset classes, such as, for example, listed futures, cash treasuries, even CDX swaps and bonds. If I can point to you, Sam.
Thank you, Lisa. Vanguard appreciates this opportunity to share with the MRAC our experience on how the markets performed during the liquidity crisis in March. Vanguard is a global asset manager that offers about 425 funds with total assets of $5.9 trillion, serving more than 30 million investors worldwide. My name is Sam Priyadarshi, and I'm a principal and global head of portfolio risk and derivatives at Vanguard. The first quarter has been an unprecedented challenge for markets, not to mention the disruption to everyone's lives that the pandemic has caused. During mid-March, much of the fixed income markets had become dysfunctional with limited liquidity and very high levels of market volatility. Trading in rates, credit, and FX markets had become extremely challenging until the Fed intervened to promote liquidity. First, let me discuss the futures and cash treasury markets. During mid-March, liquidity conditions in the futures and cash treasury markets became fragmented, and it was challenging to trade risk in meaningful size. The epicenter of this market breakdown was an unraveling of the futures basis driven by the way bank balance sheet is allocated and exacerbated by the market's reliance on high frequency and automated market making. There was a simultaneous demand for liquidity met by these cash futures basis positions alongside money fund redemptions, corporate borrowings, and FX reserve manager selling, all of which exhausted dealer balance sheets and brought the market to a grinding halt. Once the Fed stepped in with extraordinary levels of balance sheet accommodation, the markets were stabilized. The daily average bid-offer spread to trade 100,000 DV01 for U.S. Treasury futures contracts spiked in mid-March. 100,000 DV01 is equivalent to approximately 1,200 10-year U.S. Treasury futures contracts, or about $108 million of 10-year cash treasuries. Spreads earlier this year had been a quarter to half a basis point, but increased to 1 to 2 basis points during the depth of the liquidity crisis, and it took several weeks to return to more normal levels. Taking a closer look at daily liquidity, there was a period of several weeks when there was not enough liquidity to be able to consistently sweep 100,000 DV01 in U.S. Treasury futures. We traded large orders using algorithms over longer periods of time. The liquidity constraints were most significant in the longer end of the curve, where U.S. long bond and ultra bond futures contracts experienced very low levels of liquidity. Market depth was shallow, top of book liquidity was light, and contracts were trading several ticks wide. By April, trading large size was possible in the front end and belly and intermediate futures contracts, albeit at much higher costs. But long end liquidity remained patchy for several more weeks and still has not returned to prior levels in terms of available liquidity and cost to trade. Let me now turn to on-the-run U.S. cash Treasury markets. The liquidity was consistently much lower, more fragmented, and cost more to trade, much lower risk than the U.S. Treasury futures markets. The daily average bid-offer trade spread to trade just $25,000 DV01 of risk in on-the-runs for each point on the U.S. Treasury cash curve spiked to 3 times wider than normal. This trend for cash Treasuries persisted through April and into May. Off-the-run Treasuries were a completely different story. As the market quickly transitioned to the first ever widespread work-from-home model, electronic markets remained operational, but the trading in cash markets became fragmented and dysfunctional. For several days through the depths of the volatility crisis, several banks told us that they could not trade off-the-run Treasuries. Those who would still make markets did so at very wide spreads. These liquidity challenges persisted while private market was unable to provide liquidity. The markets only began to function again once the Fed stepped in to stabilize the markets. Credit markets were similarly stressed and dysfunctional. Amid the liquidity grab, accounts focused on selling shorter maturity bonds to raise cash. The premium on liquidity and the repricing of risk assets contributed to the inversion in credit spread curves, while bid-offer spreads in investment-grade cash bonds experienced significant widening. Prior to the COVID pandemic, corporate bond spreads averaged about 2.5 basis points. During the liquidity crisis, that average spiked to between 10 to 20 basis points, and there were even days when dealers refused to bid for corporate bonds. In credit derivatives, CDX IG bid-offer spreads widened from about a quarter basis points in normal environments to 4 basis points during the crisis. But this was nowhere near the magnitude of widening in cash corporate bonds. For example, during even the most stressed days, one could trade $100 million in CDX IG on the CEFs for a bid-ask spread of 3 basis points. In comparison, trading $100 million in cash investment-grade bonds would have been done at spreads between 30 to 50 basis points if it could be done at all. Conditions have improved considerably since the Fed announced their corporate bond credit facilities on March 23rd, and overall functioning of the credit markets has largely been restored. That said, we find that liquidity has not fully returned to prior levels, and the futures and cash treasury and corporate bond markets still remain vulnerable to shocks. However, during the peak of the liquidity crisis, we found it easier to trade listed futures and CEF-traded interest rate swaps and CEF-traded CDX swaps than their cash counterparts. Chair Tarbert commented earlier that the derivatives market remained resilient through the turmoil and market volatility earlier this year and worked the way they were intended to work. Our experience certainly corroborates that. Vanguard, along with many other asset managers, benefit from the ability to trade on listed futures exchanges and on CEFs, and these benefits are attributable to the Commission's current CEF regulations, which have advanced improvement in liquidity, price transparency, expanded competition, and trade efficiency. Thank you very much.
Thank you, Sam. That was very insightful. I'd like to now recognize Lee Betzel from CME, who I believe had some further color to share on futures market activity. Lee?
Thank you, Stephen. I think what has been clearly talked about up to this point already was that there was a true need to access transparent and open markets in order to be able to manage risk and exposures in a time of unprecedented volatility. I think our experiences of the exchange-traded markets especially during the end of February and March, when volatility was at its most extreme, demonstrates that despite, as one would expect, some slippage in bid-offer spreads, the ability to be able to manage exposures and to conduct transactions in larger and in some cases much larger than normal size, the ability to do so was clearly there. That was demonstrated in the CME markets by record volumes in a number of our asset classes. So the ability to be able to transact large volumes throughout the trading day, and in fact 24 hours a day, was there and available. Just a few statistics on that. The average daily volume for all of Q1, and remember that the volatility kicked off towards the last week of February, but taking into account the entire quarter from January to March, average daily volume on CME markets was 27 million contracts per day, and approximately half of those of that volume came from our interest rate derivatives complex, so averaging about 13.8 million contracts over the quarter, and in fact five of our top 6 all-time record days were completed during this period, where we did more than 55 million contracts transacted in a single day. I think that those statistics show that the ability to be able to transact and to transact in large size was there, and to do it in an order book where the bids and offers are transparent and accessible. Just a couple of other statistics. As I said, our interest rate complex showed 13.8 million contracts a day on average during the quarter. That was an all-time record, 34% higher than Q1 of 2019. But other asset classes also saw all-time record volumes. Our equity complex traded some 6.5 million contracts a day, more than double the same quarter 2019. The crude and refined markets and energy overall also saw extreme volatility as the supply and demand really shifted during the COVID crisis. There we also saw record volumes of the 3.2 million contracts a day, which was 38% higher than Q1 2019. Also metals, primarily precious metals, saw record volumes, more than 58% over Q1 of 2019. So I think that, as I said, that ability to be able to transact in an open order book and to be able to do so in large size demonstrated that that the need to access liquidity was actually there in the time when it was most needed in this unprecedented volatility. And with that, I'll turn it back over to the moderators.
Thank you so much, Lee, for your thoughts. We'd like to point now to our colleague Biz Chatterjee at Citi. Biz, if you wouldn't mind perhaps giving us some views from the dealer perspective on how the markets may have functioned during the period of volatility. And we will ask that perhaps all of the comments going forward, since we have an embarrassment of riches of comments, to try to keep them fairly brief, as we also have other members of the subcommittee who'd like to weigh in. So thanks so much, Biz.
Lisa and Stephen, thank you as chairs of the Market Structure Subcommittee for allowing me to present comments on behalf of Citi. Thank you to Commissioner Bellum for being a very engaged sponsor, and Alicia for doing a fantastic job of stringing together this meeting. Finally, thank you to CFTC Chairman Tarbert and the rest of the commissioners for responding to market conditions, providing relief in March and April, because, as all the indications we've seen from the presentations, markets were in a really deep hole back in March, but your actions and relief have helped the market come back really quickly. Just a few observations from my side, reflecting how we as a dealer saw the market and how it kind of impacted the market structure. We've heard about, the issue around how a lot of trading, we saw volumes increase in block size. That was certainly our experience as well. And that's where the flexibility of the trading protocols on the steps, the ability to use voice, RFQ to 1 really helped move some of the larger block trades. We did experience trouble with trades that were just below the block size, and especially I think the commentator from Vanguard, my colleague Sam, mentioned that challenges with long duration, 15 to 20 years and longer, were difficult to execute. One thing I'd like to point out that, the block trades are typically set on notional, whereas the market looks at risk from a O1 perspective or a duration perspective. And when rates collapsed post the Fed auction, that really had an impact of taking the same notional and creating a larger risk profile for it. So we think that, that some of that definitely impacted the inability to, trade what seemed like nominal sizes because of that increase in risk duration. We saw a big interlinkage between the various markets. We noticed in March that, the fluctuations in the Treasury market, the lack of liquidity certainly impacted the ability for a lot of swaps traders to be able to not hedge their risk in other cross markets. We certainly felt that the lack of liquidity in the Treasury future market certainly compounded the lack of liquidity in the swap market. We also did notice that, post the Fed action and as the volatility in the Treasury market died out, the swap market notional and the volumes and the liquidity did pick back up to close to normal levels. Finally, I think, to wrap it up, to speak from a market structure perspective, we certainly saw fewer market participants actively trading in this marketplace. We also saw, certain marketplaces who act as intermediaries between various rate markets and other cash and derivative markets who kind of hedge between swap futures, treasuries, treasury cash markets to kind of, seem to be more adversely impacted as they were conducting their day-to-day operations. So, Lisa, with that, I will, stick to your guidelines and conclude my brief comments.
Thank you, Biz. I'd like to turn next to Rob Mangrelli from Chatham. And Rob, welcome your perspective, particularly your insights into how end users fared during this time. Rob, do we have you on the line?
I think Rob may be having some audio problems, so perhaps we'll move on if it's okay, and if Rob can come back on after, we'll point to him again. But if you don't mind, perhaps we can point to Craig Messenger at Virtu, who, if you wouldn't mind, Craig, perhaps mentioning how you saw the experience from the CCP perspective during the volatile period, and whether, for example, you may have seen benefits to things like portfolio margining programs. Turn it to you, Craig.
Yeah, thanks, Lisa. I'll try to keep, first of all, I want to thank the Commission and Commissioner Benham and Alicia for their commitment to the various task forces and the MRAC mandate. Also, special recognition to all the commissioners for your availability and engagement during, the last 5 months. It's been outstanding. My observations are a little bit along the lines of the fact that, we've seen unprecedented amount of good activity, whether it's the regulatory bodies, the Fed, administration, whatever, and their ability to recognize problems that popped up and willingness to engage in dialogue has been really nothing short of amazing, and, excellent job all around. But there were some unique challenges that occurred, particularly in March, and continue with how CCPs and their members have to manage volatility spikes. And the differences in the application of margin, especially when there's a Fed backstop, when a Fed backstop is not available, has put certain markets in a little bit of a difficult time that probably wasn't talked about as much as the debt markets were talked about. Now, I'm going to focus a little bit on equities just because it's an easy one, and I think it'll resonate a little bit with the folks on the call. If you think about U.S. equities and the surrogate and derivative products that we see, ETFs, options, index futures, et cetera, there's really not a lot of predictability to how the market structure is evolving and or how participant behavior is evolving. You go back about 9 months ago, zero commissions became a popular product, if you would, with retail. And then when you put the stay-at-home restrictions together, you saw retail participation lift from, let's say, an average of about a year ago, March of 19, of about 6% of the average daily volume, to a peak of around 24% in March. And post-March, I think it's ranged somewhere between 16 and 22% of the daily volume. That's a huge change. You've also seen an enormous explosion in managed accounts, low-cost index products, and obviously ETFs. And the size, the notional size of these trades has been enormous, not just prior to this issue, but all during this time. And why is that? They need to meet transition, rebalancing, or asset allocation needs of these passive investments. And even though these trades were typically executed as agent, the spike in volatility required a much higher level of margin to be posted at the CCPs, as an example. And it's right at a time where, the need for liquidity is higher, and in many ways it's being reduced because there's nothing like a Fed backstop, as an example. there's also the fact that the underlying stocks are also increasingly concentrated, right? So whether it's Google or Apple, there's such a big proportion of these sort of underlying indices or these mandated managed accounts that they disproportionately tilt trading activity. Another dynamic, for example, is high-priced stocks. When's the last time we've seen a split? So there's a lot of high-priced stocks, and this also kind of feeds into this equation. So when I think of it, you've got this sort of phenomena where the CCPs are doing what they're mandated to do. Their models and their activity are well documented, but many of those things were put together in a different time, where you didn't have this sort of concentration, high-priced stocks, individual investors at a much bigger percentage of the activity, and kind of a behavior that investment managers need to perform, which really doesn't work well with the current construct. So we know that the Fed has been an active participant in remediation and standing up programs for the debt markets, but I'm not aware of any similar effort in the equity markets or its derivative components. So that kind of asks the question, should there be this discussion? Should there be programs in the future that the Fed considers or the regulatory bodies working with the Fed consider to help smooth out markets like equities and maybe options and others that don't really have as many offsetting capabilities? So what I can share with everybody on the call is the interest in the industry seems to be pretty high to engage in these discussions. Certainly over the last couple of months, I know of a number of people on this call that have been involved in a few of those. There are a number of efforts underway with the traditional regulatory bodies that touch markets like that, the CCPs themselves and advocacy groups. And I know there's been a number of discussions with various commissioners at the CFTC as to whether those are impactful and important things to potentially consider going forward. So, I think that's going to be something for the commissioners to advise us on. But, the general overview, Lisa, is that, we've got a marketplace that never anticipated the type of market structure changes that it's seeing. We've had levels of volatility, although it seems to be less chaotic now than it was then, that really spike the needs. And it's right at a time where liquidity is most needed. And, the result is market makers have to really either cut back on what they do in terms of the size of liquidity they would be willing to provide. Spreads tend to widen. And then ultimately, you're somewhat draining liquidity just at a time where both market participants and market makers and individual investors need that liquidity to be bigger.
Thank you, Craig. I think we have Rob back on, so let's hand the mic back to Rob. And then I know we have, after Rob, 3 more folks who have also raised their hands. So just so we can get everybody in the next 10 minutes, let's try to keep everybody quick.
Yeah, Stephen, thank you. This is Rob. Hopefully you can hear me okay this time. Just wanted to share my experience at Chatham Financial. We are the largest independent interest rate and foreign currency derivative advisory firm. Part of our capacity is executing risk management transactions on behalf of our client base, which is predominantly end users, including financial end users. I'm going to speak specifically to some of my own personal experiences on CEF trading during the month of March on behalf of my own customer base. During the month of March, I estimated that I traded somewhere in the order of magnitude of about $5 billion of notional, including list trades, somewhere in the order of magnitude of $3-4 million of DV01. I would say just generally, now that March feels like an eternity ago, the themes that I kind of pulled out of my own personal experience was, many of which have been covered here already, where there were some instances of dealer liquidity providers failing to respond to RFQs, not to the point where I wasn't able to transact, but definitely when situations, prior to some of the increased volatility, I would have been able to quickly get back, somewhere, let's say 3 to 5 quotes. Sometimes I was only getting back 1 to 2. Clearly, there was some widening of bid offer. I would say along those lines as well, some evidence of decreased liquidity in what I experienced in terms of, poor winning level to, let's call it, not just cover, but further down to like last level. Oftentimes that spread could have been at the height, maybe 5 basis points from the winning level to, the last place dealer. And a number of instances of increased latency of response. I would say, one of the bigger high level topics that, I took away from that was that, I think going into this crisis, I knew that, various liquidity providers had differing levels of investment in their own, systems and technology to support their CEF activities. And I think that, as part of this experience, maybe something that is worth considering, investigating further is just, with the movement from that we had to experience with people having to work from home, just how much of that, technology contributed to some of the experiences and some of the outcomes people experienced on CEF trading, for example, as opposed to, maybe voice trading. So I'll leave it there. I know we're kind of pressed for time.
Appreciate it, Rob. Thank you. I'd like to next recognize Salman Benai from IHS Markit to share his perspectives.
Thanks, Stephen, and thank you, commissioners and fellow members of the committee. I'll just be very quick. I know we're stretched for time. So, we've been monitoring the markets from a number of different perspectives as a post-trade trade processing system, as a leading index and pricing provider, but also as a company that employs a number of macroeconomists that provide macroeconomic forecasts to a variety of financial institutions as well as public companies. So we, from our perspective as a trade processor, I can corroborate some of my colleagues' discussion. The ability to transact is there. In terms of operational performance, I think the market infrastructures as well as us perform well under increased volatility and increased volume. We've seen one interesting point, which also corroborates the point I think Lee made earlier. With the elevated volumes, we actually saw in the rates markets, we saw generally greater volumes. Greater notionals, with the exceptions of 30-year U.S. dollar and euro swaps, which implies a large amount of risk transfers were occurring, in the aftermath of the COVID crisis. From our perspective as an index and pricing provider, we've seen stabilization across the cash and derivatives credit markets, with one notable exception, which is the CMBS markets, particularly BBB and lower credit rated CMBS. We're seeing still significant drop-offs from the February highs. Although even those lows are still off of the trough hit in March, and I'll do the risky thing, which is to predict a little bit about the future, because as I mentioned, we have a number of macroeconomists that I work with. As we look into the markets in the future, we see the roll-off of a number of CARES Act protections and support facilities as a likely increasing volatility in months to come, to say nothing of the election. So while volatility is currently fairly low, relatively low, particularly when looking at recent history, it may be a bumpier ride in coming months. Thank you.
Thank you. I'd like to turn now to Graham Harper from DRW on behalf of the FIA Principal Traders Group. Graham, can we ask you to share your thoughts?
Sure. Thanks, Stephen. First, I want to thank the Commission and the committee members for all the work put into this meeting today and for the opportunity to participate on the committee. I'll be very brief, but from the perspective of FIA PTG, which I think most everyone is aware is a subgroup of FIA representing principal trading firms. There's general agreement markets functioned well overall through what's been a period of significant volatility and high volumes. As a group, we were committed to remaining active in the markets where we trade to ensure participants had access to the liquidity they needed. And for DRW specifically, our data demonstrates that across asset classes, our market share increased meaningfully. I think market-wide data would illustrate that PTFs continue to actively participate in the market and further dispel the narrative that PTFs as a group tend to back away from providing liquidity during times of high volatility. And we would very much welcome any such analysis done by the Commission. Thanks.
Thanks very much, Graham. We also received a question from Eileen Keeley from BlackRock. If you'd like to share your views.
Yes, thank you very much. It's Eileen Keeley from BlackRock. Just a few comments. I think we'll echo what we heard from our colleagues at Vanguard, Citi, and Chatham, that we did have some real issues getting efficient execution for our clients during some of the more volatile periods, which is interesting that it contradicts the high-level data that we saw from the three presenters. So I was very interested to see that, specifically the trades just under block sizes, and we also had problems with the RFQ3 requirement. What I think I'll do is just make a comment on what I think that means, which I think it demonstrates a need for flexibility on these rules, particularly during volatile markets. I think the thresholds that have been set have been done through a normal, stable market lens and are not likely to hold up during volatile markets, and we believe they did not hold up. And we think that some of the reluctance to get some of the quotes that we were hoping to receive were perhaps because of dealers' concern over real-time reporting requirements. So I think we would suggest that, perhaps the Commission consider separating block size from real-time reporting requirements, and also reconsidering some of the RFQ3 requirements, but also put in a mechanism where block sizes can be quickly recalculated during times of high volatility, and perhaps size them on liquidity and risk-specific issues rather than just notional. And I'll leave it there.
Thank you, Eileen. And for our last comments, last but not least comments for this portion of the section, I'd like to recognize Marcus Stanley from AFR.
Thank you. This is a question to presenters. We heard some very impressive information from Claris and others on how well the derivatives markets performed, and that they stayed flexible and handled the stress very well. But then we also heard from Sam Priarchi in the comments, and also Craig Messenger, as to the importance of Federal Reserve intervention in the underlying markets, and how important that was. And a couple of others have mentioned that as well. Did any of the presenters look at the impact of sort of the indirect impact of Federal Reserve interventions on creating liquidity for the derivatives markets, and how much of the good performance was related to that, and was related to the dates those facilities and so on went into effect?
Hi, it's Chris at Claris. I think it's a very interesting point to raise. On my final slide, in terms of looking at the uncleared markets, that was the exact link that we expected to see between cross-currency swaps and the central bank FX facilities. We expected, because there was a clear constraint in dollar funding, that once these facilities were open, that not only would banks access the facilities, but also that the volumes and hence the implied liquidity in some of these derivatives markets would get better as well. Now, unfortunately, because uncleared markets are not as transparent as cleared markets, we can't draw any conclusive facts from the data that's available at the moment. But if we assume that it was a consistent portion of the market that was reporting to US SDRs, there isn't any evidence in these uncleared markets specifically that those central bank FX swaps actually led to an increase in dollar availability in bilateral markets.
Thanks. Do other presenters have any thoughts, or others have any thoughts?
I think this concludes the Market Structure Subcommittee's moderated discussion. Thank you so much to all who participated.
Thank you, Lisa and Stephen, for a very informative discussion. Now we will have the report of the CCP Risk and Governance Subcommittee. The co-chairs are Alicia Crichton and Lee Betzel. Alicia and Lee, you have the floor.
Great, thank you, and good afternoon, and thank you to Commissioner Benham, Alicia Lewis, Nadia Zakir, and the MRAC for allowing us to provide an update on the progress of the MRAC CCP Risk and Governance Subcommittee. Before starting with the update, we wanted to thank the members of the CCP Risk and Governance Subcommittee who've committed an extraordinary amount of time and effort to advancing the goals of the subcommittee during particularly challenging times. The MRAC established the CCP Risk and Governance Subcommittee to provide reports and recommendations directly to the MRAC regarding issues impacting clearinghouse risk management and governance. As an update to the December 2019 subcommittee report, we've structured the committee into a series of work streams in order to advance the more detailed discussions required to produce actionable recommendations and detailed best practices to the MRAC. Each work stream is led by 2 subcommittee members, and the details are as follows. Margin is Dale Michaels and Alicia Crichton. Default Management, Kevin McClear and John Murphy. Governance and Transparency, Lee Betzel and Marnie Rosenberg. Stress Testing and Liquidity Framework, Richard Berner and Matthias Graulich. Capital and Skin in the Game, Robert Steigerwald and Dennis McLaughlin. Commencing in mid-May, the subcommittee has started to meet on a weekly basis to discuss each of the work streams. At this stage, each of the work streams has met at least once. It's important to note that while the subcommittee has agreed upon a series of topics to review and provide recommendations on, it is possible that the recommendations may not be agreed on by the subcommittee, and therefore a summary of the discussion will be provided to the MRAC. At this time, we'll provide an overview of the topics under review in each of the work streams and anticipate providing the final work product to the MRAC at the final meeting in 2020. I'll hand it over to my co-chair, Lee Betzel, now to provide workstream specific updates.
Thank you, Alicia, and I'll just also echo my thanks to the broader Market Risk Advisory Committee, the commissioners, Commissioner Benham, as well as Alicia and Nadia for all the hard work on putting these meetings together and to providing us the opportunity to discuss the important topics of, in this case, CCP risk and governance and how we contribute to the stability of the broader financial markets. As Alicia said, we have 5 work streams focusing on various topics with a goal of producing final reports at our final meeting of this year. The topics being discussed include margins at CCPs, and the topics under discussion are the importance of pricing feeds and best practices associated with establishing prices for mark-to-market and initial margin setting, margin period of risk in CCP initial margin models, additional add-ons to initial margin, including liquidity and concentration margin, margin and volatility floors in times of low volatility, which we obviously haven't experienced these last few months, and as well best practices around intraday margin calls, both routine and non-routine. So that is the margin work stream. We have a separate work stream covering default management practices. There was a subcommittee of the MRAC who reviewed default management practices in 2015 and 16. Our subcommittee of this MRAC is reviewing the recommendations that were made at the time with the intention of providing an update on progress against those recommendations and providing comments on where those recommendations still have further work to do or are no longer relevant for that matter. Third work stream is governance and transparency. Within that work stream, we have split into two separate work streams, one focusing on governance aspects of CCP oversight and the other focusing on transparency. Our meetings to date have focused more on governance and will also turn to transparency in the latter half of the year. We're also reviewing the current rules, CFTC rules for application of changes to CCP rules, namely the 40.5, 40.6, and 40.10 processes. We're reviewing that, how CCPs currently apply them, and whether there or not there are any recommendations that can be made for improvements there. Thirdly, we continue to review potential enhancements to the framework that CCPs use to obtain and address input from market participants on relevant risk issues. The fourth work stream is on stress testing and liquidity frameworks at CCPs. We have used and reviewed a number of reference materials in this work stream, including best practices for stress testing and best practices on the topic from CCP 12. Also reviewing CFTC supervisory stress tests and other papers, including stress testing networks, the case of central counterparty, published in December 2019, and Jerome Powell's central clearing and liquidity. So topics under discussion here are defining clear goals needed for stress tests, recognizing the distinction and overlap or alignment between supervisory stress tests and those done by CCPs, scenario design for stress tests, and liquidity stress tests. And the final work stream is on CCP capital and skin in the game. The work stream is reviewing CCP capital regulations, issues previously considered by this body, recent developments in Europe under EMIR 2.2, quantitative disclosures regarding current levels of CCP, skin in the game, and general discussion of CCP capital regulation. And with that, the subcommittee is working to define commonly used terms. For example, CCP capital versus skin in the game, as well as the applicability of position paper focused on more narrowly defined topics. The subcommittee would welcome any questions or feedback that you have on the discussed areas of focus at any time, and we'll continue work of the subcommittee. With that, I'll turn it back over to the moderator.
Thank you, Alicia and Lee. We'll now open the floor to questions and comments from the membership on the report. I guess just to clarify, just in the meanwhile, it sounds like really the topics, obviously that are before this subcommittee are not only critical but also complex. And in terms of your objective with respect to the final work product, with respect to each of the work streams, maybe could you just clarify, is the goal there to, for certain work streams, potentially come up with some recommendations, whereas for others, perhaps more of a summary of sort of the relevant positions across the different types of members? Maybe if you could just clarify that point as well, that'd be helpful.
Sure. This is Lee. Thank you for the question. I think our purpose is to review relevant best practices on the topics that we've outlined, decide whether there are areas which could be improved upon in making CCPs safer, and where there is consensus in the subcommittee to make recommendations as appropriate. Where I think there are potentially topics under discussion where there is not broad consensus in the subcommittee, and where we do not see a need or cannot come to a consensus on making recommendations per se. I think our goal is to be able to set out the positions on the topics just to provide clarity to the broader Market Risk Advisory Committee.
Okay, great. Thank you. That's very helpful. Okay, well, if there are no questions or comments on the CCP Risk and Governance Subcommittee report, let's turn to our second panel of the day, titled COVID-19's Impact on Margin, Processing, and Operational Health in Cleared Derivatives. Our speakers are Richard Haynes, Supervisory Risk Analyst, Risk Surveillance Branch in the Division of Clearing and Risk at the CFTC. Richard, are you on the line?
I am on the line. Can you hear me?
Yes, thank you. We also have Sai Srinivasan, Deputy Director, Risk Surveillance Branch in the Division of Clearing and Risk at the CFTC. Sai, are you on the line?
Yes, I'm here. Thank you.
Thank you. We'll have Alicia Crichton, Subcommittee Co-Chairman, Global Co-Head of Futures and Head of OTC Prime Clearing Business, Goldman Sachs, representing the Futures Industry Association, as well as Lee Betzel, Subcommittee Co-Chairman, Managing Director and Chief Risk Officer, CME Group. After the presentations, we will move into the moderated discussion. At that time, we will take questions and comments from the members on the presentation. Richard, I will turn it over to you.
Thank you very much. I'd like to begin by thanking Commissioner Benham, Alicia Lewis, and Nadia Zakir for giving me the chance to present this afternoon. For my presentation, I will provide a brief background on the CFTC's Clearing Risk Surveillance Branch, where I work, followed by a few high-level observations about clearing trends in the first half of this year. This period experienced extreme volatility and market uncertainty, especially during the month of March, and led to elevated liquidity demands on clearing members and their clients. Fortunately, the system has been designed to handle these market fluctuations, and clearinghouses weathered the storm even with unprecedented operational changes like broad work-from-home requirements. The next slide. I start the deck with the usual disclaimer. None of the material in this deck represents the official views of the agency, the Commission, or CFTC staff. With that noted, on the next slide, I have summarized a few of the responsibilities of the Risk Surveillance Branch. As one of the primary analytical parts of our clearing division, we are tasked with daily risk monitoring of clearinghouses as well as their members, as well as longer-term analysis like analyzing the adequacy and appropriateness of CCP margin models. During periods like earlier this year, we are in regular contact with market participants to understand the risk management responses and their preparedness for extreme market volatility. To guide us in this monitoring, we collect detailed data on all cleared derivatives positions in our jurisdiction, as well as the margin held against these positions. We regularly stress test these positions to ensure there is adequate margin coverage and back tests to better understand how models responded to historical periods of volatility. We have also now published 3 supervisory stress tests that have analyzed not just the dynamics of individual CCPs, but also the liquidity demands of derivative CCPs as a whole under stressed conditions. With that brief overview of the branch, I will move to a few high-level observations of the last 6 months. The following slide summarizes the initial margin collected in 2020 by the CCPs under our jurisdiction, broken down by asset class. Generally, futures and options on futures, abbreviated as F&O in the chart, and rate swaps are the largest product classes, with both representing roughly 45% of total collected IM as of the end of June. Margin levels in aggregate increased from around $440 billion at the start of the year to a high of just over $600 billion at the end of the first quarter. This translates to a roughly 40% increase in margin during that quarter, with a slow decrease in levels as volatility fell in more recent months. And you can see this in the blue line within the chart. From this chart, we can see that the derivatives markets we oversee responded quickly to changes in market conditions, especially during the middle of March, and margin levels have remained high since then, continued protection in case of a return of market uncertainty. The next slide adds variation margin payments to the analysis. Here, the red bars represent the daily VM calls by derivatives CCPs, while the blue bars represent the incremental IM call on a given day. Both of these measures hit their highest levels in the middle of March, with daily VM calls peaking at over $50 billion. For historical context, VM calls on the day of the Brexit vote, one historically high day, were roughly $30 billion. 11 days in March exceeded that level. Though incremental IM demand was also historically high during March, I do want to contrast the two margin calls. There has been discussion recently about potential stresses put on financial markets due to the liquidity demands of IM calls. As you can see from this chart, though IM calls did increase in March, on an aggregate basis, these demands were far outweighed by those due just to the day-to-day change in portfolio value. In addition, these large IM demands were mainly isolated to a few days. Once IM levels increased to levels appropriate to the increased volatility, few large additional calls were necessary. I should note, as a caveat, that VM demands do represent flows from one to another part of the market, liquidity that can be reused by payment receivers. This is not the case for collateral like IM. So we continue to analyze both IM as well as VM trends in 2020 to better understand the effects of liquidity demands on market health. The chart on the next slide focuses strictly on VM demands, the lion's share of the payments made against cleared derivatives positions. I've earlier noted that margin demands are strongly correlated with volatility levels. And we can see here in this chart the strong relationship between VM levels and one commonly used volatility measure, the VIX. I do want to emphasize, however, that derivatives products should not be considered one homogeneous bucket of assets. Though we do see a strong relationship between the two measures, there are exceptions. For instance, the two measures do not peak on the same day. This is in part due to the fact that the VIX, equity volatility, may not always move in tandem with fixed income volatility or currency volatility or commodity volatility. Divergences like this occurred in the first quarter, with spikes in one not always coinciding with spikes in another. In addition, there are often differences between implied, which is what the VIX measures, and realized volatility levels. These facts highlight that our risk surveillance often needs to consider each product class independently with its own unique features. Continuing this theme of heterogeneity, I will finish with a breakdown, not by asset class, but by participant type on the following slide. On this last slide, I have shown the first quarter change in initial margin requirements for a few of the large customer participant classes. In an earlier slide, I noted that IM requirements rose roughly 40% during the quarter on an aggregate basis. You can see here at this more granular level that there is a much broader spectrum of changes. For the slower money entities like insurance companies and pensions funds, IM growth was very similar to the aggregate. In contrast, hedge funds, often considered more fast money accounts, actually saw a slight decrease in IM requirements quarter on quarter. As volatility rose, hedge funds as a group reduced positions such that they retained a roughly flat risk profile. Like the previous slide, this demonstrates that there can be no one-size-fits-all monitoring program. For some, we need to understand how participants are affected by higher margin demands on a roughly fixed portfolio. For others, we need to understand how they are likely to adjust, and sometimes rapidly adjust, portfolios to changing market conditions. It is addressing challenges like these where we have worked and continue to work to build analytical tools to make sure the CFTC is, as a former chairman described, a 21st century regulator for 21st century markets. I thank you again for the chance to present today, and I will now symbolically pass the microphone over to the next presenter.
Sai Srinivasan?
No, Richard was covering for me, so we're waiting for, I think, Lee Betzel or Alicia to take over.
Okay, great. But then, thank you, Richard. Alicia, you may begin.
Thanks very much, Nadia. As stated overall by other participants, the markets and the clearing mechanism function particularly well, especially during the early parts of the COVID crisis. The extremes that we witnessed during the height of the pandemic, as we've discussed many times throughout this meeting today, have led to many records, whether it was exchange volume, cleared volume, size and frequency of margin increases in an abbreviated window, CFTC seg funds, trade counts. By pretty much any measurable metric, we've broken most records that we've tracked, all in an environment where most participants in the industry managed a transition to an almost 100% work from home environment. We believe that as the analysis of the impact continues, there will be some interesting lessons learned that will influence the work of many in the industry, including both the FIA as well as many MREC subcommittees. FIA conducted an industry survey in June, and while the results showed the industry performed well during recent market volatility, there were several areas that should be studied and recommendations reviewed to continue to strengthen the resilience of the clearing system. Areas of focus included unpredictable changes in margin, clearing operations and trade settlements during stressed market conditions. If we can move to the next slide. Thanks. To provide the appropriate backdrop to some of the comments, we'll start with a look at market volumes. This table shows the trading volume for all exchange-traded derivatives in the U.S., including options on stock and stock indices. The total number of contracts traded in March was significantly larger than any previous month in the history of the industry. The scale required to process this type of volume on a daily basis is significant, and on the back of that, FIA is working with members on a global initiative to use the lessons learned from this period of high volume and volatility to identify ways to improve operational efficiency within the cleared derivatives industry. To reference a few data points from our survey, 40% of survey respondents cited issues with clearing operations and systems. 30% referenced a high number of trade breaks as challenges that were exposed during the COVID-19 crisis. And just to make a note on the survey, for challenges noted, respondents to the survey were able to pick more than one criteria. Just so back to kind of the slides here, one of the initial areas of focus that FIA is looking at is in regards to how CCPs manage their end-of-day clearing cutoff times on T0 during periods of high volume, and how firms and CCPs can work together to address some of the specific challenges that were identified. One in particular to note, due to the volumes, many FCMs requested clearing window extensions, and many CCPs were accommodating of those requests throughout the period of volatility. FIA plans to focus on how communication and transparency around this process can be improved, and we think the FCM community would benefit from some concise guidelines on how to request clearing window extensions. Separately, the FIA understands that the extension of clearing windows can be disruptive to the end-of-day processes at some CCPs and some FCMs as well. We hope to find ways that these challenges can be overcome with improvements in technology and other operational workflows. We're also considering whether recommendations should be made for longer end-of-day clearing cutoff times if they are deemed to be necessary. We can move to the next slide, please. This data depicts US FCM customer margin collected from 2003 through April of 2020. This data comes from the CFTC's customer segregated account data. Although we're just representing data from US FCMs, we do feel like it's a good proxy for the global industry. US FCMs collected an additional $136 billion in collateral from their customers during the month of March. That represents more margin for cleared customers than ever in the history of the CFTC, and certainly more than the peak of the financial crisis in 2008. So here's how that breaks down. For total customer funds and futures accounts, from March 2020, customer collateral was $318 billion, up from $214 billion from February of 2020. So an increase of 49% in a single month. Total customer funds and swaps accounts were $153 billion in March, up $32 billion from the $121 in February, an increase of 26% over the prior month. Certainly record-breaking increase for swaps markets, but not to the same degree as futures. Note that the client segregated funds continues to remain high today. We also thought it was interesting to draw attention to the number of FCMs represented on this chart by the orange line. While seg funds have grown approximately sixfold since 2002, the number of FCMs is roughly half. We can move to the next slide, please. Thanks. So we'll spend the next few slides reviewing the impact of the crisis on margin, in particular initial margin, which we're focusing on as the first line of defense rather than mark-to-market flows or VM. To reference again the FIA survey, 76% of respondents identified margin volatility and unpredictability as a challenge needing review post-crisis. This chart shows the percentage changes in margin requirements for some widely used global futures contracts. What is striking about the data from March is both the size and the frequency of the increase. The sizes of the increase create procyclicality and liquidity concerns, and the frequency can create both liquidity concerns and potential operational stresses. We can move to the next slide, please. We wanted to take a closer look at the IM increases on a few global equity index futures and compare those increases. We start with the S&P 500 E-mini futures contract. The IM requirement began the year at $6,300 per contract, and by March 2nd, it had risen to $6,600. Over the next 3 weeks, IM was increased 6 times due to the extreme price movements. By March 23rd, IM had been raised to $12,000 per contract, nearly double the amount versus the beginning of the year. We look across to Eurostoxx 50. As we saw with the minis, IM was very stable during the first 2 months of the year. From Jan 1st through March 10th, IM stayed within a range of 23 to 2,700 euros per contract, but between March 10th and April 15th, IM more than doubled. And then looking at the last example for the Nikkei 225, IM was raised from 720,000 yen at the beginning of March to 1.62 million yen by the end of the month, which works out to be an increase of roughly 125% in just a short few-week period. The trend then reversed direction, and IM was reduced 3 times in April and then 3 more times in May. I think the key risk is demonstrated here is that margins move quickly from low levels to peak levels in a very short period of time, potentially exacerbating market stresses. Next slide, please. Thanks. Based on quarterly disclosures by CCPs, we've compiled some statistics on margin breaches. The number of margin breaches more than doubled between Q4 and Q1. The average size of margin breaches increased fourfold over the same period, and this is aggregated data at a contract level. While we can and do expect margin breaches, these stats clearly highlight the challenges both FCMs and CCPs face during this time and the strain that can result from a cycle of margin breaches followed by margin increases in rapid succession. To wrap it up, FIA is focused on a few key themes based on the lessons learned from this data. Improvements to the guidelines and transparency around some operational workflows, advocacy work based on the feedback regarding the issues raised, and that work will focus on limiting impact of reactivity to volatility changes which may exacerbate liquidity stress. For example, calibration on collateral requirements, the margin levels are neither chasing volatility down nor spiking as quickly as volatility. Focused on the work around CCPs adopting appropriate and conservative anti-procyclicality measures, taking into account specific characteristics of cleared contracts and at least 10 years of history of patterns and changes in volatility. The potential use of margin floors calibrated to include a history of market volatility, and those measures surrounding margin floors and the anti-procyclical approach chosen by CCPs should be transparent to the market. Thanks very much for the opportunity to provide some overview comments regarding these last few months.
Thank you, Alicia. Lee Betzel, I'll turn it over to you.
Hi, thank you again for the opportunity. I have put together some slides focusing on some of the same themes that we have already covered, both in this report and on the previous subcommittee reports. So I'll try not to be too repetitive. However, I did want to focus on a few of, as I said, the key areas and observations during the hugely volatile period prompted by the COVID crisis. The data that I've used is mainly drawn from a paper which was produced by CCP 12 earlier this month. That paper is called CCPs Again Demonstrate Strong Resilience in Times of Crisis. You can find that paper on ccp12.org website, and I encourage you to have a look through. But I have tried to draw a few highlights from the paper, which I'd like to cover now. So, Alicia, if you can move to the first slide. We've talked about it quite a lot already, but just to put in context and to remind the committee, the events that we saw, especially during late February and March into April of this year, really is and has been hugely volatile. The stress that we've seen, the market gyrations that we've seen, are events that are nearly unprecedented. You can see in the chart on this slide, as demonstrated by the CBOE's VIX product, that the volatility as measured by VIX exceeded that of 2008 and spiked in very, very short order to over 80. So this has been incredibly stressful to the market, and the conclusion overall that one can draw is that CCPs have, during this time of stress, operated with a very high level of resilience and have done what they're meant to be and meant to do. That is to provide stability and assurity to the market in times of stress, that market participants and those with exposures to the volatile markets have a place to manage that risk. We can just remind you that it was because of the 2008 global financial crisis that the G20 in Pittsburgh in 2009 made a commitment to move OTC markets into a cleared environment because of the stability and resilience that CCPs at that point had demonstrated for exchange-traded derivatives during that crisis. Let me please move to the next slide. Just slightly more context on the market volatility. It shows a few representative graphs just to give a pictorial or graphic picture of how extreme the volatility has been. In the lower left graph, we're seeing and we have seen price moves that we haven't witnessed since the crash of 1987, and in fact approached the volatility seen during 1929. Likewise, in the crude and refined markets, market dynamics led to the highest price volatility we've seen since the Gulf War in 91. That was led off with the Saudi Aramco strike back in February, if you recall that. And then the dynamics of supply and demand led to huge price swings in March, and in fact led to negative prices being traded in April. Likewise, the U.S. Treasury markets, you can see from the graph just how much the markets moved on a daily basis with high stress, and in fact seeing the entire curve trade below 1% for the first time ever. So just in context, this is extreme stress that we have seen during this period. Next slide, please. Talked a lot about volumes already, so I won't focus too much here, other than to say these have been record volumes of cleared derivatives across almost all asset classes across the globe. I won't focus too much on that as we've already covered that. So I'll move to the next slide. Despite the huge increase in demand for capacity of exchange-traded and cleared derivatives, CCPs held up well. I think, as Alicia pointed out, the huge volumes did require, in some instances, for there to be more processing time for post-trade activities, and most CCPs were responsive to that. But that being said, with some maybe later than normal times, the core clearing systems at major CCPs held up extremely well during this period. And you can see in the graph on the slide what's being reported through the public quantitative disclosures. This is from the Q1 report until the end of March. You can see for major CCPs that the core clearing system availability was in line with what we witnessed in Q4 2009 and approaching 100% availability across all core clearing systems. And of course, like the entire industry, CCPs across the globe were almost all in work from home environments, using tools to access their clearing systems and their colleagues in that work from home environment. I think I'll move on to the next slide. So we have talked a bit about initial margin responses at CCPs already. I think it's fair to say that given the unprecedented stress and spike in volatilities that we saw during the COVID crisis, initial margin models at CCPs did what they were supposed to do. As a way of reminder, initial margin at CCPs is not set out to cover the most extreme but plausible scenarios. That's why CCPs have default resources, and in most cases mutualized default resources to cover potential losses in the most stressed times. Margin is an important part of the default resources, and for most CCPs, margins are set to cover expected losses above 99% of cases, but not in the most extreme cases. So when you do have a spike in volatility like we witnessed, you would expect margin models to respond and increase in line with the increase in volatility. Most CCPs operate margin models which try to recognize the importance of having anti-procyclical measures in their models. So for most CCPs, you will have seen that the increases, albeit large, increases were spread out, they were measured, they were given with notice, and the increase took place over several weeks during March. Likewise, on the way down, as volatility drops, initial margin models seek to slow or dampen down in case there is a sudden spike again, and we're still in that period for the most part. Initial margin did increase. You've seen some statistics already. Again, I've taken data from the public quantitative disclosures for a number of major global CCPs, reflecting the increase in margin held at CCPs over the quarter. I compared that to Q4 of 2019. There were some large increases, but as I said, those were for the most part done over an incremental basis. And the consequence of the response to the spike in volatility was appropriate. You can see from the lower left-hand chart the results of backtesting of initial margin to show the achieved coverage level at the portfolio level. Of course, at a contract level, there will be initial margin breaches if a CCP sets its target coverage to 99%. You can expect there to be margin breaches at the contract level, but it's much rarer to have margin breaches at the portfolio or account level. And that's what's reported in the PQD's 6.5.3, and I'm reflecting here the margin coverage, which you can see did slip at most CCPs somewhat, but still well above a 99% and in many cases 99.9% target at the portfolio level. So demonstrating that the initial margin increases were appropriate. Next slide, please, Alicia. Just to make the point, I also have some data points around variation margin. So you can see, again, broken down by for a few major CCPs. You can see the increase in variation margin. Again, variation margin is a pass-through. So this is a resetting of the risk in the portfolio by collecting losses from portfolios which are deteriorating and paying out to those who are gaining due to market fluctuations. And just to reiterate the point that Richard made earlier in his slides, a couple of examples of contract level variation margin flows in relation to initial margin increases. The top chart being the 10-year Treasury note future, where you can see there were very large dollar amounts of variation margin flowing. There were also a number of increases in initial margin. Those are the black lines on the bar chart, the upper one, showing that there were initial margin increases and several of them over several weeks, but small in comparison to the variation margin required due to price movements. And similarly, a chart over S&P 500 index contracts, where the dark blue bars are the variation margin amount and the light blue bars are initial margin increases. I think with that, I'll stop there and look forward to discussion. Thank you again very much for the opportunity.
Thank you, Lee. At this time, we'll move into the moderated portion of today's discussion on COVID-19's impact on margin processing and operational health and cleared derivatives. And I am going to turn it over to Robert Steigerwald, Senior Policy Advisor, Financial Markets at the Federal Reserve Bank of Chicago.
Thank you very much, Nadia, and thank you to the presenters, Richard, Alicia, and Lee, for a very stimulating set of presentations about recent events. I will moderate a brief discussion given time, but I hope to involve members of the committee as broadly as possible. If members of the committee would like to ask questions, remember, as earlier in the program, to follow the instructions on how to post your question. To kick things off, I would like to focus on the issue of operational resilience in the cleared markets. This issue has been touched upon several times during the discussion today, and I wondered whether any of the presenters in this panel would like to compare the operational experience that they endured, I suppose, is one way to think about it, during the recent crisis, and compare that to the observations that were made earlier in the discussion about how working from home may have had an effect on responses to RFQs. So basically a cross-market comparison of how working from home may have affected operational processing. Would anyone like to discuss that? That question seems to have no takers. That's all right with me. Are there members of the committee that would like to ask questions of the presenters? Please let us know through the chat function whether you'd like to be recognized.
Is it okay if I answer your first question?
Yeah. Who is this? Is this Lee?
Yeah, this is Lee. Sorry, I was trying to give some others the opportunity to jump in,
Sure.
But I think the operational resilience is a really important factor. Us within the CCP community, as well as our FCM clearing members and other participants, were almost in their entirety having to work from home. I think that as an industry we have benefited from. Sorry, I heard interference there. I think that over especially the last 5 or more years, we have all worked hard to develop tools which enable a working from home environment. In addition, we've gone to kind of global support for our markets. I know in the case of CME, we operate a follow the sun risk management regime. So we have staff who are working in Asia, in Europe, in the Americas to support and monitor our markets, and that's necessitated developing tools to be able to carry out those tasks. And a very important part of our business continuity planning is the ability to be able to work from home. So we do that as part of business as usual. In response to the COVID crisis, we moved to a near 100% working from home, which did present some challenges to the capacity of our networks. But my view is that it has worked extremely well, not least in our default management processes. We did during this period have to go through a liquidation event of a clearing member, and that default management process, our liquidation and auction processes, were all had to be done using tools that we've developed to be able to do so remotely and using web-based tools. Even that we were able to carry out. So, with that, I think the industry has done a very good job of adapting, and as such, we were able to cope with this sudden crisis. Thank you.
Thank you, Lee. Would anyone else like to comment on their experience? I'm not hearing any, and I'm cognizant that time is growing short for this discussion. Nadia, if we have no questions from the committee members, I would propose to turn this back to you so that the committee meeting can be concluded.
Thank you, Robert. And once again, thank you to all of the MRAC members for today's discussions. This concludes today's agenda. Thanks again to our presenters for joining us today. Many thanks to the subcommittees and their chairs for their hard work, and we look forward to hearing your final reports at the end of the year. I will turn it over to Alicia Lewis.
Thank you, Nadia. Before we go to closing remarks, I'd like to revisit the 3 members that were not able to get on the record, just to make sure that they are on the call. Can you please unmute yourself and indicate your presence once I call your name? Dick Berner?
I am here, Alicia.
Excellent. Derek Kleinbauer.
And have been all the time.
Yeah, same here. It's Derek Kleinbauer.
Thank you. And Marcus Stanley. Marcus Stanley.
Alicia, he asked a question earlier, so
Yeah.
he was clearly on part of the call.
Janine Tramontana.
Yes, Alicia, I'm here.
Excellent. Now that I have you all on the record, thank you again. So now it's time for closing remarks. We'll start with Commissioner Berkovitz, then go to Commissioner Stump, then Commissioner Quintens, Chairman Tarbert, and then Commissioner Benham. Commissioner Berkovitz.
Thank you, Alicia, and thanks to all the market participants. The presentations today were really exceptionally informative. I appreciate the data-driven analyses and the extensive data analysis that went into the presentations, and I'm heartened to really see in the data the robustness of the markets in the face of these unprecedented challenges. This is really a testament to the strength of the Dodd-Frank reforms and the market participants' commitment to these reforms and the way of trading, and on trading also to see the market moving towards towards SEF trading and more transparency, even where not mandated. On the 10th anniversary of Dodd-Frank, that's a great birthday present to hear this news. So I thank all the market participants and Alicia and Nadia and Commissioner Benham. This really was an excellent presentation. Thank you.
Thank you, Commissioner Berkovitz. Commissioner Stump?
Thank you, Alicia. I just want to echo what Commissioner Berkovitz has already said. I thought the presentations were really well done, very informative and timely. And I also want to commend all of those who've continued to work on the legacy priorities of the MRAC that were ongoing long before the current pandemic overtook events. It's important that we not allow those things to take a back seat. That work is critically important, and I appreciate all of the effort that has gone into the meeting, but also the work leading up to the meeting. So thanks to everyone who was involved.
Thank you, Commissioner Stump. Commissioner Quintens?
Thank you, Alicia, and thank you to you for your hard work putting together. Thanks, of course, to Commissioner Benham, Nadia, and all the subcommittee chairs. I agree with both my colleagues. The presentations were excellent. They're very informative, very insightful, and it seems as though we have, the key people putting those together and giving us their viewpoints, which make these advisory committees so special for our agency. So thank you for a very productive day.
Thank you, Commissioner Quintens. Chairman Tarbert?
Thank you, Alicia, as well, for your hard work in putting this together. Thank you, Nadia, for chairing it. And, of course, thank you to Commissioner Benham for your leadership as the sponsor of the committee. Like my colleague said, this has been a really terrific session, filled with lots of perspectives from all of you, from what you've seen during the last few months since the last MRAC meeting, and particularly during the COVID crisis. The stories that you've told, the facts that you've put forth have all sort of helped inform us as we think about our ongoing response to the crisis and also sort of larger policy issues in the future. And then as well as the longer term projects that all of you reported on, it was really helpful to understand where you are on those, and all of them are very important, and encourage you to consider moving them forward. So once again, thank you so very much for your time. It was really a productive session. Thank you.
Thank you, Chairman Tarbert. Commissioner Benham?
Thanks, Alicia. I'm going to take a few more minutes and identify the individuals who participated and did all the hard work as we did in the morning. But it's worth taking the time because the work's been tremendous. The day's been fantastic, and obviously none of this could have happened without the leadership of course, Alicia Lewis and Nadia Zakir as the chair and the DFO, Tom Whiff, Bob Litterman, Lisa Shemy, Stephen Berger, Lee Betzel, Alicia Crichton. Thanks for all of your work as subcommittee chairs. A tremendous amount of sort of lifting going on given what we're dealing with COVID. And as Commissioner Stump said, your commitment to these issues, regardless of what we're dealing with, both at home and in the workplace, is tremendously valuable and important to the long-term success of our markets. I do want to thank the chairman and commissioners Stump, Berkovitz, and Quintence for participating today. Again, we have a busy week ahead of us starting tomorrow and Thursday, so their commitment and willingness to take time this morning and this afternoon is hugely beneficial to all of us to have them listening in, and of course, as we deliberate policy for the agency going forward. Just a few points about today's discussion, starting with the SOFR and the benchmark reform conversation, and reiterating some of the things that Tom Whiff said. The CFTC remains committed to the transition process. Thanks to the entire subcommittee for all of the work they've been doing, truly critical to the entire process of transitioning. And as I've said from day one, which is now several years ago, been trying my best to ensure that the CFTC sort of remains a supplement almost in part, but an additive work stream to the larger effort being done by the Fed domestically, especially in New York, and then the overseas bodies, including the FCA and Bank of England. So we'll continue to work, I think, as requests come in, as things change, as we work towards the end of 21. And as I said, be nimble and flexible where appropriate to provide relief when it's appropriate, but certainly doing what we can as quickly as we can to ensure that the transition process continues. Thanks to Bob Litterman and the Climate Subcommittee. As Bob mentioned, we were hoping to have a report, I think, sometime in the early summer, but obviously with all things and all the subcommittees, the COVID pandemic has slowed things down, understandably. And I know they're continuing to work very hard, and looking forward to the work product they're hopefully able to deliver in the next couple of months. But I really appreciated Bob's parallels and the question I think Nadia asked about COVID and climate, and I think there are things that we should sort of recognize and identify and piece together as we're dealing with one pandemic and one health crisis, and how we have to manage and think about the climate crisis that is starting, has been going on for a number of years, but the data and the science, which we so much rely on within the context of our work, is telling us that we need to be better prepared. And then finally, I'm going to sort of, the market structure and the CTP risk and governance discussions were fantastic. I'm going to start with Chris Barnes, and thanks to Claris for participating, but love the notion that transparency works. And Commissioner Berkovitz, touched on this a little bit, but 10 years past Dodd-Frank, certainly didn't get everything perfect, but there's a lot, I think, in what Chris said about pre- and post-trade transparency, reporting, central clearing. I mean, these are hallmarks of course, Title VII, but also the larger Dodd-Frank goals. And I think as people are reflecting on what was accomplished, what works, what doesn't work, I think those are core reforms that I think, as I mentioned, were sort of shock absorbers for the March-April period, but certainly things that we should all be mindful of and proud of as we sort of look to the future and look to future risks. That said, I think it was pretty clear that not, as much as, the markets worked, and that I think we are largely pleased with what outcomes we have from the March-April period. There certainly are a number of issues, and I think those were raised today. Anything from execution, which I know Eileen mentioned, to Alicia's excellent deck from FIA on customer margin, the number of FCMs and sort of that relationship, and then of course customer money, and then obviously the IM demands that we saw in the March-April period. So a lot of things that I think that we can elevate and shine on as positives about the past few months, but certainly more work to be done to sort of fix either some minor issues or issues that didn't result in either breakdowns or larger systemic problems, but certainly things that we have to be cognizant about, I think, as a group, and I think as from my perspective, we'll continue to advocate for these issues, speaking about them, using the MRAC to sort of discuss them in a collaborative way, and then if it's appropriate, raise them to the Commission for more in-depth policy consideration. So a lot of work to be done, I think a lot to be proud of, but certainly many good things to glean from the past few months, but also many lessons learned, which I think demand and require more conversations and more work from all of us to ensure, again, more transparent, better, safer markets. I think we should be happy with what we accomplished, but that shouldn't be a reason to rest on our laurels here. We should move and sort of strive for, perfection, even though it's, largely unattainable. We should sort of point our North Star there and try to get there as best as possible. So I look forward to helping it, be a part of that conversation, leading it if I can, and sort of learning from all of you to the best extent possible. And I do want to mention one more thing before we wrap up. I mentioned some of the, I made some comments in my opening statement about some of the issues going on in our country with respect to, social unrest and racial inequality. And I've asked Alicia Lewis and Nadia, as the DFO and the chair, to sort of put their heads together over the next couple months and start thinking about a panel, just a sort of informal panel discussion at our next meeting, which will likely be in December of this year, to talk about diversity and inclusion in our markets, in our industry writ large. Something I care about. I've talked to my fellow commissioners, and I think there's a number, and the chairman as well. There's a number of steps that obviously have to sort of be accomplished before we get to the panel discussion, but I think given the conversations I've had with my colleagues and with Alicia and Nadia, I think it's a smart thing to do. I think it's the right thing to do, and I think the Commission and my colleagues as well support it, and having this, planting the seed in terms of figuring out if we can have an in-depth, positive, forward-looking conversation about diversity in our industry. And couldn't be more pleased with Nadia and Alicia. Alicia obviously fulfills many responsibilities at the CFTC as an attorney, but also as the DFO of the MRAC. But she's also a leading voice on diversity issues at the CFTC. So I can't imagine someone better to sort of help spearhead some brainstorming about invitations to individuals in our industry. And I would welcome any of you as either individuals or institutions who have been thinking about this. I know many of your institutions do. If you want to be a part of that conversation, I'm sure Nadia and Alicia would welcome that. So we can look, and of course, hopefully some deliverables from our subcommittees and just more work in the next few months. Certainly, I hope everyone remains safe, has some time to break in the next few weeks in August before Labor Day with their families. Obviously, challenging times, but I'm confident we'll get through it. And as always, I am here to discuss things, to talk about things. I said this in March to a few of the subcommittees, if not everyone on the entire committee. Work life and home life is priority. This is a huge benefit and something that I care about deeply, but given the challenges we're dealing with, certainly prioritize what's most important in life. But if there's anything I can do, please don't hesitate to reach out. So thanks again to everyone. Stay safe, and appreciate all the work. Alicia, I hand it back over to you.
Thank you, Commissioner Benham. In addition to everyone that's been thanked so far, want to also extend thank yous to our AV and logistics team. Carrying out these virtual meetings is not an easy task, but they help us do it seamlessly. So thank you to our AV and logistics teams, and thank everyone for attending this meeting. The meeting is now adjourned.